All right, so we are starting with the formula session. Now, the intention of this particular session is that you must have learned the entire curriculum once, then you must have revised it, and while doing so, you must have realized that a plethora of formula, too many formulas, and you want something to be at a particular place where all the formulas are available. Now, generally, you may see formula, you know, compressed at a one level and you watch it, but I generally prefer that if you want to remember all these formulas, which is a task, but if you want to remember, it's better you write it down. So this is something that I used to do as a candidate. I used to write down all the formulas, take a print of it, put it on the wall so that I don't forget things. Now, yes, many people will tell you that you should not memorize in CFA. I agree, but sometimes the data is too much. You may know the concept, but you may not recollect it. So this is something for the last moment, that what all the formulas are in. This is like to reduce that anxiety that I don't miss out on the formulas. Okay. So the objective of this session is, yes, I'm assuming you have revised the syllabus, you have gone through the concepts, you know the in and out, and then we are revising the formula. While learning the formula, if we come across any issue, we probably don't know the derivation of it. Some of the formulas are unnecessarily put up as per me. I don't think so. You should memorize them. I'll discuss all of that. The objective is what is essential for exam, what should I do on a priority, and what should I avoid, or what should I not get into the depth of. So, the session will be into two parts. First part, we will focus in book one, the book one that I have from a fast track revision book. In this book one, we first focus on the first five topics. This is how we did in the revision also: equity investments, then we focused on fixed income, derivatives, alternatives, and economics. This section has around approximately 180 to 200 formulas. So let us start writing all the formulas. We will go reading by reading. So first we will move to reading number one of equity investments, which is valuation, application, and process. Okay, all ready? I hope you are ready with a book pen. Write it well in your handwriting so you can refer it. I will just give you one suggestion. I used to write down the formulas, and whatever I could not understand, in English, I used to write down in my language as well as a hint. You can do that, but it's better you first put down all the formulas across, right? All good. Let's start with the first formula. In the first topic, we are going to have a formula which is going to focus on the valuation. Remember, in the first reading, valuation, we were focusing on intrinsic value. Intrinsic value is derived throughout the equity. But in the first reading, there is only one formula, is about mispricing. Are you aware about mispricing? Yes. Guys, here you can participate also. This annotated notes will also be shared with you. You can also print it. You can, but I would suggest you to better write in your own notes, right? So mispricing, yes, mispricing. There are a couple of formulas related to mispricing. In reading number one, there are only mispricing formula. Mispricing is divided into two parts. Yes, actual mispricing, and the next one is valuation error. Valuation error. So yes, anyone would like to contribute? What is mispricing? Mispricing is the difference between intrinsic value and the actual market price, or the current market price of the stock. But there are two types of intrinsic value, one derived by the analyst and one which is actual. Mispricing is the difference between the analyst intrinsic value. Am I correct? Analyst intrinsic value and current market price. So, is there a difference between analyst intrinsic value and actual intrinsic value? Yes. What is that called? The difference between the intrinsic value derived by the analyst and actual. Yes. Analyst can make an error. So, that error, that is the difference between actual intrinsic value and analyst intrinsic value, that is called valuation error. So the mispricing has two components: actual mispricing and valuation error. Actual mispricing is the difference between intrinsic value by intrinsic value, which is actual, and the current market price. So if you now notice, in fact, if you add The actual mispricing and valuation error, if you add these two formula, you get the mispricing. Now, assuming the analyst has correctly valued the stock, right? That means there is no valuation error. If there is no valuation error, mispricing and actual mispricing is same. Mispricing and actual mispricing is same. The CFA Institute puts actual mispricing as true mispricing. So sometimes they use a word called true mispricing instead of actual mispricing. Everyone clear with this? Right? The reading number one had just this as the formula. All right? Correct. This is your reading number one. Reading number two of equity is about the dividend discount models. In this, you had single period, multi-period dividend discount model, maximum formula in this and the free cash flow topic. So first, we will focus on the dividend discount model under which we use single period and multi-period dividend. Yes, anyone would like to contribute? What is a single period dividend discount? Well, what is the objective here? We are trying to derive intrinsic value. So intrinsic value is referred as V0. Single period. In one period, you will only get D1 and price discounted with cost of equity. Cost of equity, you can say KE or RE, doesn't matter, right? Cost of equity. This is single period DDM. Here, there's no Gordon's growth. Gordon's growth is single stage. We'll discuss that later. Two period or multi-period DDM. In multi-period DDM, guys, in multi-period DDM, you may have dividend for, let's say, 1, 2, 3 years. And at the end of third year, you will also derive something called terminal value. I've taken an example of 3 years. It can be 4, 5, anything. So guys, what is the terminal value? Terminal value is the value when you sell the stock, or it's your end of forecasting period. This we discount using our cost of equity for 1 period, 2 period, and 3 period. In a DDM model, you already have the terminal value, but we better derived it using Gordon's growth model. So now I will focus on Gordon's growth model. Everyone in the class, Gordon's growth. So let's focus on Gordon's growth formula, which is what are more crucial for us. Okay, Gordon's growth. So first of all, just to summarize what we've done till now, we've done reading one, valuation error, actual mispricing and mispricing. Reading 2, we starting with DDM model. This model is very simple. You've done the same in level 1 also, right? The interesting thing is when we move on to Gordon's growth. All right, everyone with me? Correct? I hope you guys are writing. All right. In the Gordon's growth, we have single stage that is called constant growth model. I will write down. We have constant growth model. Then you have similar to dividend discount model, you have a two-stage or multi-stage model. So I will write two-stage. You have a two-stage model also. You have three-stage. In exam, you generally have maximum three-stage, but we rather write it as multi-stage model. And the unique thing that you have not learned in level 1 is the H model. H model. Everyone with me on this? Correct. Okay. Under either of the model, you will forecast the future dividend, and at the end of the period, you will forecast the terminal value. All right. Yes. Let us start first with constant growth model. Again, remember, we are trying to derive what? We are trying to derive the intrinsic value. So under the constant growth rate model, our V0 is based on D1 over R minus G. R is cost of equity. Everyone clear? All right. How do we break down the D1 as? D1 is D0 into 1 plus growth rate. Perfect. Yes, this is your constant growth model. All right. Now, in a two-stage or three-stage, right, in a multi-stage model, you can skip writing this, but it's okay. If you write it also, it's not a problem. In a multi-stage model, very interesting thing, we will, let's say, we assume three stages. So we will have D1. D1 can be at a growth of 5%, 15%, D2 at 15%, D3 maybe at 10%, D4 maybe at 10 percentage or lesser also. And they may use a word that after 4 years, the company will grow at a perpetual growth rate or a constant growth rate of 5%. So the point where they say after this point, the company will grow at a constant rate, that is where we derive what? We derive what? The terminal value. Yes. Terminal value. We'll discuss about the terminal value. But when we derive the terminal value, guys, before that, we do what? We just discount all of them with the respective cost of equity year. The interesting thing here is the terminal value P4. Now, guys, P4 is based on D5 over R minus G. Are you with me? Here, which growth rate will I take? I will take the normal or the constant growth rate. GN, you can say GN or the normal growth rate, constant growth rate. But the previous D, these D, they are at what growth rate? They are at abnormal growth rate, or we say high growth phase. So this is high or abnormal growth phase. GN can also be said as low growth or constant growth phase. All right. How do I derive D5, guys? D5 is D4 into 1 plus which growth rate? The normal growth phase. Are you with me? So the growth changes, that growth is inculcated in D5. From D4 to D5, the growth changes, divide by R minus G. That will give you your terminal value. In this reading of dividend discount model, terminal value is derived using Gordon's growth. In relative valuation, terminal value is derived using P ratios. So you can find the fourth year P ratio and fourth year earnings you can forecast. So it can also be derived using relative valuation, which we will see in market-based valuation. All right. Everyone clear? Single stage and multi-stage? Any problem till this point? Yes. Okay, cool. Right? Perfect. Now, I will first discuss the H model. In H model, what we do is that we break down the dividends, the valuation. This is the unique thing, and this is something that is highly testable also because H model was not discussed previously. Now, very important, we are trying to find the intrinsic value using the H model. Write down intrinsic value using H model. All right. Now, H model, there is a normal formula and there is a shortcut. I will discuss both. In the normal formula, the first part, that is D0. D0 is the recent paid dividend into 1 plus the long-term growth rate, long-term or the normal growth rate, divided by what we do, we divide it by the R minus G to make it constant. R minus G. Now this portion, there are two parts, by the way. One part we will discuss that second part, but this part, the first part is based on the supernormal growth. The first part is the first part is about, sorry, the first part is about the constant growth phase. The second part is about, in the H model, remember the most important thing in the H model, that H is what? It's the half of what? Half of the transition phase. So in that case, we do D0 into H, and everyone in the class knows what is H. H will be the transition phase, which they will say that the stock will, uh, the growth was 5%, 15%, then it will fall to 5% over the 5 years. Over the 5 years. So it is half of what is H? H is half of high growth phase. I hope you understand high growth phase. So let's say they say the stock will move from high growth phase to low growth phase in the next 10 years. So if they say 10 years, half of that will be my H. All right. Into the difference between the short term and long term growth rate. So I will do the short term growth rate, which is high, and the long term growth rate. The difference between both, even this is going to be discounted with R minus G. So we will do R minus R is cost of equity minus GL. Everyone with me? Understood this? Clear? Right? Okay. Now, in this case, what is common you can pull out? Yes, you can pull out the common. The common part is D0, everyone, and divide by R minus constant or long-term growth rate. That is common amongst both the equation. So, what is left over, everyone? From the first part, what is left over? We can place that here. All right. What is the first part that is left over? 1 plus long-term growth rate. All right. And in the second part, what is left out is H into the short-term and long-term growth rate. The difference between H and the short-term and long-term growth rate. That is the leftover part. So you can use the shortcut also in case if you want. This is where you will first derive this, store it, solve the second equation, store it, and multiply recall one with recall two. You can do this as well. Remember, short-term growth rate is high, long-term growth rate is low. Is this clear, everyone? Just be careful where there is plus, where there is multiplied. Anyone has any doubt in this? Anyone? All right. Yes. Perfect. Now, in between here in this topic, we also have the valuation for a perpetual preferred share. For a perpetual preferred share, the only thing you are going to get is preference dividend, which you can say is like a D0, divided by cost of preferred equity. Cost of preferred equity. So instead of cost of common equity, we say cost of preferred equity. This is just a very simple formula that we all have learned in L1 also. I rarely expect that to be tested, but we'll write it down. Perfect. Till this point, everyone clear? All the equity valuation, including preferred share valuation. Yes. Now, in this topic, one of my favorite is PVGO, present value growth opportunities. And by this point, when you have reached, I'm sure everyone has seen PV related question. Okay. Even though the formula is simple, we derive the intrinsic value with the perpetual earnings. So we take E1, expected earnings, and discount it with cost of equity. So we discount it with the cost of equity. This will give us the valuation for the earnings part. So we assume the earnings will be perpetual. So that is one part. This is one portion. And the second portion is PVGO. Now, what is PVGO? If you remember, PVGO is based on the earnings being retained. So it is the value of reinvested earnings. What is PVGO called? Full form is present value growth opportunities. But what is that? That is the value of the earnings not paid out. That is retained. This in exam, be ready. They may ask you to either find PVGO or they may provide you PVGO and ask you to find the intrinsic value. This is one of my favorite from this topic. H model and PVGO are very, very important because they are unique in level 2. All right. Till this point, yes. Now, cost of equity, we will use in this model, dividend discount model, we use the simple CAPM cost of equity. And everyone knows what is CAPM cost of equity. You will see this repeated so many times in the syllabus. Risk-free, risk premium, RM minus RF into the beta. This is your simple CAPM cost of equity. And then the growth rate, which is called sustainable growth rate. Growth rate, we all know, is sustainable growth rate is retention into ROE. Correct? ROE, retention into ROE. ROE is what we break down as DuPont ROE. So if I want to do the DuPont ROE, DuPont ROE also repeated multiple times in the syllabus. DuPont ROE, we break down into net profit margin. That is, net profit margin is net income over sales into asset turnover ratio. Asset turnover ratio is sales over total assets into financial leverage, which is total asset over total equity. That is called financial leverage. You can further break it down into 5-point ROE also. This is 3-point ROE using DuPont, everyone. So this is your breaking down of net profit margin, asset turnover ratio into financial leverage. Correct? Actually, there is an acronym for this. This is, see, the acronym is called Pratt model, sustainable growth rate using Pratt model, where P is for profitability, that is the net profit margin, R is for retention ratio, A is for asset turnover, and T here is related to leverage. That is called the Pratt model. They use T for leverage. Don't worry, doesn't matter. Basically, it's the same thing. Everyone clear with the sustainable growth rate and cost of equity? All good? Yes. This is where we complete the dividend model. Now, let's start with the free cash flow. Yes, we will start with the free cash flow. This is where so many formulas, multiple ways of deriving FCFF and FCFE. So now we are going to move. We did reading one, everyone clear? Reading one, reading two, so many formulas. Dividend discount model, single period, multi-period, then Gordon's growth, constant growth, two-stage, H model. H model, very important, right? Then preferred dividend valuation is very simple. And then we derive the components. But before that, PVGO, very important from your exam point of view. Okay, cost of equity, sustainable growth rate using the DuPont. DuPont, do not worry, it's repeated multiple times. Now I will move to reading number 3, which is our free cash flow. Now, guys, I am focusing on those formulas which I feel are essential. There may be some unnecessary formulas also. Of course, you can go through it. If you have any doubt, let me know. But I think these are the bare minimum that you should know. All right. So in free cash flow, we are going to value the firm using FCFF model or using FCFE model. So assuming it's a single stage valuation, first of all, we need to know what is value of firm, value of equity, everyone, using the FCFF and FCFE model. So value of firm, we need FCFF 0, that is current year, into the growth. I'm using single stage, divided by what? Divided by, for FCFF, we use WAC, 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 correct? Everyone, right? For value of equity, we just use the same Gordon's growth. Instead of dividend, we replace with FCFE. So here we do FCFE for the current year into 1 plus growth to make it expected, divided by, I will now do what? Cost of equity minus growth. Same thing, just that we change the plot. We change, instead of dividend, we replace that with free cash flow. Also, what is the, now we will describe the components of FCFF and FCFE, but what is value of firm composed of? Composed of value of equity, value of debt, value of preferred, minus cash and equivalent. Minus cash and equivalent. Cash and equivalent means short-term investments. All that is liquid. We deduct that. Everyone. And when I say value of equity, value of debt, value of preferred, I am assuming market value, not the book value. We are considering which value, guys? Market value. Is this clear? We are always taking market value of debt, market value of equity. So FCFF and FCFE component to be discussed later. But the question is going to focus on what is the value of the stock, that is value of equity. And if I want to derive value of equity, I will rearrange the formula. Then that will be value of firm minus value of debt minus value of preferred, and we will add back cash and equivalents, right? When we rearrange this, we will add back, cash, and equivalent. Is this clear? The broader picture, everyone? Now, just for your reference, all of this is in the book as well. It's not that it's not there in the books. So in the book, if you see, all of these formulas are there. There is also another way that students do, and which I used to also recommend, is that when you are reading it, mark it. But if you remember, when we were doing revision also, although it is there in the books, but we used to write down like this. Correct? Those who were there in the revision course, they know that we used to write down all these formulas. That makes our job easier. Because in exam, they might just ask you FCFF and FCFE calculation, but we don't know what variety they will ask. So we break down, it's in the books, but we write it down. The more you write down, the easier it is. Until this point, clear? If it is clear, then I will now move on to deriving FCFF using different ways, depending on what information they give in the exam. And then we will focus on deriving FCFE using different ways. All good, everyone? Yes. So FCFF, we derive using net income approach. We derive using operating income approach. We derive using EBITDA approach. And of course, we derive using CFO approach. In level 1, you just did from CFO approach. FCFE can be derived using, any idea? FCFE can be derived using FCFF from the FCFF itself. Then FCFE can be derived using a simple net income approach, same like FCFF, using operating cash flow also. And then there is actually the fourth and very important variety based on target debt ratio. It is similar to net income approach only, but if they say target debt ratio. Everyone with me on this? All of this is going to help me derive FCFF only. FCFF, FCFF, FCFF. You can also write down similar or a better way. This is what will help me derive FCFE using FCFF, FCFE using net income, FCFE using CFO, FCFE in case if they give me target debt ratio. All right. Hope you've written this. Okay. Yes. Would you like to contribute? Anyone? What goes into the free cash flow? Free cash flow first, net income approach. We start with indirect cash flow method. That is what we start with: net income plus non-cash charges, that is depreciation, and minus changes in working capital. Actually, this three: net income, non-cash, and changes in working capital. Net income, non-cash, and changes in working capital are also called CFO, right? Operating cash flow. Same as operating cash flow. All right. Net income, non-cash, that is depreciation, minus working capital is nothing but operating cash flow. But we also do what? We add interest 1 minus t, because interest was deducted and we are doing free cash flow. So we add interest, and we always do 1 minus tax, interest 1 minus t. And of course, we will deduct the fixed capital investment, because that is what is reinvested. So two extra things apart from CFO, same will help you derive FCFF using CFO also. So when I do FCFF using CFO, I will just simply add this component, interest 1 minus t, and subtract fixed capital investment. Remember, working capital and fixed capital are reinvestment. So when I subtract the reinvestment from the cash flow, operating cash flow, that is called free cash flow. But why do we add interest 1 minus t? Because it was subtracted and we are doing free cash flow for the firm. Firm means debt and equity both. Firm means debt and equity both. Yes. Everyone clear with the FCFF calculation for using net income and using operating cash flow? So simple, right? Okay. Using EBIT. When I do EBIT, we will do operating profit 1 minus tax. EBIT replaces net income and interest 1 minus T. So the component of net income and interest 1 minus T is what EBIT replaces. So excluding that, whatever remains is what we will keep. That is non-cash charges, depreciation, minus fixed capital and working capital. So working capital and working capital investment and fixed capital investment, that will be subtracted. Remember, they're always subtracted because those are reinvestment. So I just rearrange two things. Net income, interest 1 minus T is nothing but equal to EBIT 1 minus T. Rest all remains as it is. Clear, everyone? Check out where it is plus, where it is minus, where it is plus, where it is minus. Yes. Rarely EBITDA is used, rarely, but in case if EBITDA is used, EBITDA, that is the non-cash is what is added. What we do tax subtraction from EBITDA also. Now here depreciation is not deducted, but there is a depreciation tax benefit. So this is where we will add back depreciation into the tax rate. This is nothing but called the depreciation tax shield. So EBITDA and adding back depreciation tax shield actually replaces EBIT 1 minus T and non-cash. Rest all remains as it is. That is what we will subtract the changes in working capital and fixed capital. I hope you understand, you can relate. Any doubts, any question? Rarely use EBITDA 1, but EBITDA into 1 minus T plus depreciation tax shield, that replaces EBIT 1 minus T and non-cash. Non-cash is nothing but depreciation amortization. In fact, see, if you want to go further detail, you can go amortization, write down, valuation allowance, everything. But for the exam, just remember depreciation amortization. Correct? Everyone? All the four variants of FCFF. Correct? Okay. Now we will move to FCFE. While doing this, I'm assuming there is no preferred. If there is a preferred dividend, if there is a preferred share, what is the only adjustment we will do? Assume in all of this, if there were preferred share, what is the only adjustment? Now, wherever is the debt adjustment, you will see debt interest is added back. So if there was a preferred dividend, simply you will do what? You will add back the preferred dividend. Wherever there is interest 1 minus T, along with that, you will add back preferred dividend. Wherever there is interest 1 minus T, you will add back preferred dividend. That is the only thing you will do. You added back interest, you will add back the preferred dividend. Preferred dividend doesn't need tax adjustment. Okay, because it is already paid from after tax. Is this clear? So just a simple thing, if there is a preferred dividend, since you added interest 1 minus T, add back preferred dividend without the tax adjustment. All good? Now let's focus on FCFE from FCFF. So from the FCFF, debt goes out. So what will go out? Interest will go out. So interest 1 minus T will be adjusted, and then we adjust for net borrowings. Guys, when I'm writing net borrowings as add, I'm assuming net borrowing is what? It is borrowing minus repayment. What is net borrowing? Net borrowing is borrowings minus repayment. Remember, when I put plus, I'm assuming what? Borrowings are more. So it's a cash inflow. However, if there's a repayment, this number will become negative because then it's a cash outflow. Clear? Okay, this is what will give me FCFE. Now, if we open up the FCFF already had interest 1 minus T. When I open up and subtract interest 1 minus T, interest 1 minus T is out. So what is left? It is net income plus non-cash charges. Interest 1 minus T is out. Minus fixed capital, minus working capital, and net borrowings. Net borrowing is a new element here. All right. Interest is out and net borrowing is replaced. Using CFO is a component of net income, non-cash, and working capital. So net income, non-cash, and working capital will replace. Remaining is fixed capital investment, and again, net borrowing is the only difference. Perfect. All right. CFO adds the depreciation, right? Depreciation is added. But if not, check out the fourth and the most important, which is actually related to net income. This is not actually a different variant, but altogether an adjustment into the net equity. This is my favorite as well and more practical. So if you remember the net income approach here in FCFE, what we just did, in that we did net income plus non-cash minus fixed capital. Now actually fixed capital and depreciation are related, right? Depreciation is on the fixed capital. So if we rearrange this net income, and now right after I write, okay, don't write net income, and then we rearrange fixed capital minus depreciation. I will put that into the bracket, everyone. This is my fixed income minus depreciation and minus the working capital investment. Now the question is, what about the net borrowings? So the borrowings will be utilized along with equity to fund the reinvestment. So what we do is that we break down the net borrowing into same things, fixed capital and working capital, because whenever we borrow, that will go to fixed and working capital. So the formula actually translates this into something that is 1 minus the debt ratio. 1 minus the debt ratio. That becomes the formula. And what is 1 minus debt ratio? 1 minus debt ratio is nothing but equity ratio. 1 minus debt ratio is nothing but equity ratio. And now when I say debt ratio or equity ratio, a simple debt ratio is nothing but debt over debt plus equity. That means it tells me how much of the total capital comes from debt. So if the debt ratio is 40%, equity ratio is 60%. Everyone clear with this? Check. Anyone has any doubt? Very important. The target debt ratio. Yes, anyone has any doubt? More chances of this as per me. Debt ratio, debt over debt plus equity. Also, one more thing here. If there was preferred dividend, where all we will adjust the preferred dividend? Same way, wherever there is debt. So wherever there is debt, net borrowings, you said, right? Instead of net borrowings, we will say net preferred share. Again, net preferred share will be what? Instead of borrowing, I will say I will say issued minus repaid. So wherever there is borrowing, not instead, if there is a debt and preferred both, we will add the preferred dividend in like the same way what we did for interest, but we will also adjust for net borrowing. Similar to net borrowing, we will say net preferred. Are you with me? I'm not writing it because that is rarely tested and I don't want you to confuse it. Just remember, along with net borrowings, we will add the net preferred. And wherever there is interest, 1 minus the adjusted, we will also adjust the preferred dividend. Everyone clear with this? Yes. Any questions till this point? This is the maximum variety that they can perhaps ask. All good? Everyone till reading number 3? Yes. Anyone has any questions before we move to reading number 4? Yes. Any doubts? Okay. Yes. Now we move to reading number 4. In reading number 4, which is related to multiples. So you had price-based multiples, all the price-based multiples, and then EV, enterprise value multiples, that is EV multiples. So price-based and EV multiples. In the price-based, you have price earnings, price to sales, price to book value, price to cash flow. Now, of that, we will first discuss what is price to earnings ratio, which is market price per share over earnings per share. So it is market price per share over earnings per share in a simple language, right? But P ratio has two variants. What are the two variants? Trailing and leading P ratio. Trailing P ratio and leading P ratio. When I say trailing and leading, the difference is in the denominator, that is the earnings. So we say here price, that is the market price per share, and in both the cases the market price, the actual market price per share we take, but which earnings do we take? In trailing we take the past earnings, so EPS of last, 1 year. So we can say EPS 0 or earnings 0 means the recent earnings. But in the leading P, we forecast the earnings, the next period earnings. So EPS over the next 12 months or next 1 year. Everyone understood with the basic difference, right? PE based on trailing or leading. This is also called PE based on comparables, where I'm using actual market price. This is where I'm using actual market price of stock. These are called PE ratio based on comparables. I'll repeat, they are called ratios based on comparables, where you will have a benchmark to compare and decide whether the stock is undervalued or overvalued. Okay. Now, the focus of the topic will be on the justified P ratio, price to book value ratio. Those are called valuation based on, this is comparables. Those are called multiples based on fundamentals. So there are two approaches. Approach one is multiple based on comparables, and approach two is multiples based on fundamentals or forecasted fundamentals. So I will write down multiples based on forecasted fundamentals. Multiples based on what? Forecasted fundamentals. This is what students should perhaps know or remember, because this is what I perhaps believe is highly testable. Here, all the P ratios, instead of that, we will say justified P ratio. Instead of price to book value, we will say justified price to book value ratio, justified price to sales ratio, and justified price to cash flow ratio. So price to cash flow ratio. All right. This justified ratio, what are the justified ratio? Everyone, very important. You can also write down this and we will write down one by one. All good, everyone? Remember here, I'm taking all leading. So I'm taking all leading. Okay. Leading means forecast. I'm forecasting, right? So we are taking all leading. Justified is for forecasting. It's not for the fast. It's not for the past. Okay. It's for the forecasted. Yes, everyone. So what do we write it? We say P over E1, I will say E1. So P0 over E1, I will say P0 over book value per share next period, P0 over sales per share. Everything remember is in per share next period. And I will write price over cash flow per share next period. Next period makes it what? Leading. Good, everyone? Yes. I will directly write the formula and then you guys can tell me if you are aware, not aware, if there is any doubt. Yes, anyone would like to tell me what are the components of justified leading P ratio? Here, the price is based on, why is it called forecasted fundamental? Because the price here is not the actual price, it is the Gordon's growth price, which is our intrinsic value. That is the difference between forecasted fundamentals and comparables. In comparables, we take the actual market price. Here we take the forecasted using Gordon's growth. Clear, everyone? Yes. what should be the PE ratio, leading PE ratio formula? It is D1 over R minus G, which was always there. But now we are replacing on both sides with, we are dividing on both sides with earnings. So dividend over earnings, that dividend over earnings is nothing but what is it called? That is called payout ratio, which is nothing but 1 minus retention ratio. So this divided by R minus G. R is cost of equity. Everyone with me? Right? So instead of this, you can write the original formula also. The original formula is 1 minus B, and this is nothing but B is retention ratio. So I will write 1 minus B is nothing but dividend over earnings. Is this clear to the class? Good. Okay. Justified leading price to book ratio is very important. Yes, because it is so important because it is repeated in the residual model also, residual income model. In justified price to book value ratio, the final version of the formula, what we do is that the dividends are multiplied with the book, dividends are divided with the book value. Then we translate that dividend is nothing but earnings into payout ratio. So earnings over book value becomes your ROE. So yes, anyone would like to say what is the formula here? It is ROE. I'm writing the final version of the formula that you should remember. ROE minus growth over, very good, excellent. ROE minus growth over R minus G. R minus G. In fact, R minus G is common for all. Okay. R minus G, R minus G. That is going to be common. Okay. Yes. Clear, everyone? ROE minus G over R minus G. This is the final version. Justified price to sales ratio actually takes net profit margin. So we take the net profit margin, and this is very interesting. We take the net profit margin. What is net profit margin? That is earnings over sales. Earnings over sales. And then after earnings over sales, the remaining part that we have is after earnings over sale, the remaining part is same as justified PE ratio. That is 1 minus the retention ratio, that is payout ratio over R minus G. Do you notice the difference between price to sales and price to earning? The only thing that is different is your net profit margin. So if you multiply price to earnings leading, justified leading PE ratio with net profit margin, you get justified price to sales ratio. Everyone clear with this? Understood the difference? Yes. Anyone doubt? Okay. In justified price to cash flow ratio, here we derive the free cash flow. So generally cash flow can be any cash flow, but here we focus on the FCFE. So how is FCFE derived? Here we know the component of FCFE, right? FCFE, expected FCFE, we derive the FCFE, and that FCFE is what we use in our reference. Now, my suggestion is justified leading price to cash flow ratio. You can skip it because it simply replaces FCFE over R minus G. Remember, FCFE over R minus G will give you what? Value of equity. So actually, we do what? We do the pricing where we take FCFE into 1 plus G over R minus G. That is what we derive the valuation. That valuation of equity is going to replace here. So perhaps you should not focus on the formula side because there's no such formula being tested here. It is simply price that we have, the market, the fundamental price derived by the free cash flow. So here we will take FCFE over R minus G. That is going to be the multiple here, right? So this price over free cash flow. So here, remember, you got the price FCFE divided by R minus G. That is the valuation you will get using the single stage FCFE model, right? That divided by the cash flow per share. So we will do what? Divide by the FCFE. So actually, it is the same thing, just that the price can be derived by single stage or multi-stage FCFE divided by the cash flow. Okay. Do not worry about this formula. This formula is not so critical because the focus should be on justified P ratio, justified price to book, and justified price to sales ratio. Justified price to cash flow ratio, I'm just writing it as a formula. Remember, here the price is derived using FCFE model divided by the cash flow, expected cash flow. Okay, that is the justified price to cash flow model. Okay. Here, look at the PE ratio. PE ratio. What if I do the inverse of that PE ratio? What will I get? If I inverse the PE ratio, this justified PE ratio, if we inverse that, any idea? What do we get? Yes, we will get the payout over R minus G, correct? So we'll get the payout over R minus G. So if I simply inverse that ratio R minus G over the payout ratio, that, yes, that, right? This is R minus G over the payout ratio. This is called justified dividend yield. What is this called? Justified dividend yield. Dividend yield. Justified dividend yield. Normally, what is dividend yield? Dividend yield is dividend over price. Dividend over price. Dividend over price. I'll repeat. What is a dividend yield? Generally, dividend yield is dividend over the price. Okay, that is going to be my dividend yield. And justified dividend yield is nothing but the inverse of what? Related to the P ratio. So P ratio inverse is earnings yield, but P ratio inverse is earnings yield. I'll repeat, P ratio inverse is earnings yield, and this is dividend yield. Dividend yield is dividend over price. I'll write down both so that you are not confused. What is dividend yield and what is earnings yield? Dividend yield and earnings yield. Earnings yield is earnings over the price, and dividend yield is dividend over the price. Earnings over price and dividend over price. So those are dividend and earnings yield. Justified dividend yield is just a formality. You should not focus too much into that. Okay. Focus on justified leading, justified price to book value, justified sales is also rarely testable, but still you can focus on justified sales. Justified leading P, justified leading price to book value, and justified leading price to sales. Clear, everyone? Right? We will see justified price to book value later up coming up in the residual income valuation model also. All good? Yes. Now, before we go ahead with EV EBITDA, do you remember EV EBITDA model? EV EBITDA models? Yes. So before we go into that, there is a component which is very crucial here is underlying earnings. Underlying earnings. Very important. This is something unique, and those underlying earnings are nothing but earnings from which we exclude non-recurring items. So underlying earnings, yes, what is underlying earnings? If you check in our notes also, we had discussed about underlying earnings. If you check here, what is underlying earnings? These are the continuing or sustainable earnings. So we exclude the non-recurring items, and then normalized earnings are the ones which are adjusted for cyclicality. Two things, underlying earnings and normalized earnings. Normalized earnings are calculated using two methods. We'll discuss both. So everyone, underlying earnings are earnings from which we will exclude or subtract what? Non-recurring items. Non-recurring. Now this is adjustment that you do in the calculation, but these are underlying earnings. So all the earnings from that, you will exclude all the non-recurring items. So normalized earnings. Now normalized earnings, you will see them repeated many times in the syllabus. Normalized earnings are calculated using two methods. What are the two methods of calculating normalized earnings? The first method is using average of ROE. So we take ROE into book value per share. So we take average ROE into book value per share. Remember, ROE is what? Net income over total equity. Total equity is nothing but book value. So we do net income over total equity. We take the average of ROE maybe for last 3 years, 4 years, etc. Correct? This is called average ROE method. This normalized earning is for adjusting for cyclicality because earnings are not constant. The second is method of historical average EPS. So here we take the average of EPS, earnings per share, everyone, where we take the last 3 or 4 years of average of earnings per share. Simple. So it is nothing but the mean. So either you take the average of earnings or you take the average of ROE and multiply with book value per share. Book value per share. Here, book value per share 0 means the existing book value with the average ROE. Easy. EPS, you can just combine last two, three EPS that they mention you and do a simple average mean or simple mean. That is the EPS adjusted for cyclicality using average ROE or using simple average EPS. This is very important. Cool, everyone, till this point? Understood? Right? We already discussed what is earnings yield. Now, it's something less testable as per me, but still it is unique here in this case. That is what we do. What we are going to derive now the Yardeni model based earnings yield. Now we discuss what is earnings yield. Earnings yield is earnings over price, correct? But earnings yield using the Yardeni model and the P ratio using the same model. So now we will derive again earnings yield using which model? Yardeni model. Now this is very rare, but still it is something unique and people sometimes wonder what exactly this is. So we will derive earnings yield using Yardeni model and PE ratio using the Yardeni model. So we will derive that and the PE ratio using Yardeni model. Okay, two things. You can write down the heading earnings yield using Yardeni model and P ratio using Yardeni model. Now, the model actually is an incorrect comparison as per me. We discussed that in the class that it compares two things. First of all, it is going to give me earnings yield. And when I say earnings yield, it is going to give me earnings yield of the market. Earnings yield of the market, the entire market or index, you can say, right? This earnings yield is equal to, we compare two things. Here we take the bond yield. So it takes the current bond yield. And which bond is it? This is A corporate bond, A rated corporate bond, A rated corporate bond. From this, it's a complicated formula. So I'm just writing it down. From this, we subtract K. K is a constant factor assigned, right? It can be, if it's 5 years, we do 1 over 5, that is 0.2. Into, we take long-term earnings growth. Yes, we take long-term earnings growth plus the error. Error is always for something that the model cannot capture. So we take the error. So this model is very unique. Okay, this will tell me the earnings yield on the market. Now, just to understand the components here, check out the components. So earnings yield on the market is equal to corporate bond yield minus we take K into G. K is here a constant factor for the growth rate plus the error. All right. The Yardeni model, everyone, and the Fed model, they are used to understand whether the market is overvalued or not. So whether the market is undervalued or overvalued, the comparison is with the bond yield. So it's a reference whether the index is overvalued or undervalued. Okay. And if we take the reciprocal of this model, see now the understanding, this entire model that we derived, right? This entire formula that I derived, excluding the error. If we just take the residual of this, it becomes what? Excluding the error, right? If we just take the reciprocal of this, it becomes the PE ratio using Yardeni model. Okay. So I know this model, many students have a question that what is this model used for? What is the purpose? Yeah, don't worry about it. Just remember they help you understand whether the market is overpriced or underpriced, right? It is something that is very famous in US where they compare the Fed model, the Yardeni model, right? Just remember that the inverse of the earnings yield using the Yardeni model is the P ratio. Clear? And normally also you know what is the inverse of earnings yield? Earnings yield is earnings over price, right? So the inverse of that is nothing but price over earnings, which is P ratio. Clear? Everyone? All right. Yes. Now comes one of my favorite ratio, and you must have seen that across the syllabus, that is the PEG ratio. Yes, what does the PEG ratio compare? PEG ratio compares two things, as the name says. It compares the PE ratio divided by growth. Can you tell me, do you want the PEG ratio? When do I say the stock is undervalued or overvalued? What is more attractive, lower PEG ratio or higher PEG ratio? Same like P ratio. I have a question. No adding error. See, error, we write it for formality. We don't consider error when we calculate. Error is just to understand the model. When we calculate, we don't consider error. When we calculate any of the models, we don't consider error. Understood? So error is just for formality. We complete the model. But when we calculate, we don't consider error. We assume the model is fit. Got it? What is error? Error is the difference between the model and the actual. So for formality, we write the error, but when we utilize it, we don't take error. That is what you must have noticed throughout. Okay. Yes. PEG ratio. Yes. My question to the class. PEG ratio. PEG ratio is lower better or higher better? Which one is attractive? Everyone. Which one is attractive? Lower. Lower is better. Cool. Everyone. Yes. Now we'll focus on the EV EBITDA multiples. So what is EV EBITDA? EV, as the name itself says, EV. First, we'll focus on what goes into EV, what goes into EBITDA, and then we will get the EV EBITDA ratio. In exam, this EV EBITDA multiple, and you multiply that with the EBITDA of your company, that will give you the EV of your company. So we take the industry EV EBITDA ratio or peer group average, multiply with the EBITDA of our company, let's say XYZ, and we will get the EV of our company XYZ. That is the whole objective. In the vignettes, you will see they will give you the comparable, EV EBITDA multiples for the industry, and you will compare that with your EBITDA. Now, EV, similar to value of firm, correct? Here we take market value of equity, market value of debt, and preferred also. Here we also add minority interest, right? Minority interest is also captured because we're taking the value of the entire company, including the minorities. Remember, minority interest is subtracted in equity, right? Correct? So we add back minority interest also. And from this, what will we do with respect to cash and equivalent? We will add or subtract cash and equivalents or cash and investments. Do we add or subtract? Everyone, do we add or subtract? We subtract. Correct. Same like what we did for value of firm. All right. Here we take the market value of the debt. And when I say debt means we take long term, short term, everything. EBITDA is nothing but the earnings before interest and tax. That is your operating earnings. Correct. Add depreciation and amortization. So simple EBITDA formula, we add the depreciation and amortization. That is our simple EBITDA formula. Ironically, companies don't publish EBITDA. We analysts derive EBITDA. Free cash flow, EBITDA is what we analysts do. Companies don't publish it. Okay, companies just give you income statement. We derive EBITDA and free cash flow. Yes, everyone clear with EV EBITDA components? EV EBITDA, right? All good? Yes. Okay. Now, sometimes instead of EV EBITDA, they take TIC EBITDA. What is TIC EBITDA? I will discuss. Rarely used. TIC over EBITDA. TIC is total invested capital. And what is total invested capital, guys? Not a big difference here. Total invested capital takes company's debt, equity, and all the investments. So it does include cash and investment, cash and equivalent. So it unlike what we did in EV calculation, we subtracted cash and equivalents, right? We subtracted. Clear? In TIC, total invested capital. Here, simple difference is that we take the market value of same, what we did there, market value of all the equity, including minority interest, plus market value of debt, all the debt, short term and long term. Even if there's preferred, we take it, but we don't exclude cash. That's the only difference. Even though rarely tested, but this is TIC, total invested capital. You can check out in our notes also. We discussed that at length. Where is TIC? Here, TIC. What we do? We take what? We take the cash and equivalents. We don't exclude them. Okay, rarely used, but still. Got it, everyone? Right? Yes. Now, this topic had one very interesting thing, which actually is a component of momentum indicators, that is earnings surprise. Yes, earnings surprise. Okay, surprise, because stocks react based on that. And standardize unexpected earnings. So the second thing is standardized unexpected earnings, which is related to surprise only. Unexpected earnings. In short, it is called SUE. SUE. In short form, it is also referred to as SUE. First of all, earnings surprise. Why is it a momentum indicator? Because the stocks react based on how the actual earning is compared to expected. So we compare two earnings. One, we had an expected EPS, expected earnings, or you can say expected EPS. Compared to that, what was reported? What was reported EPS? So that tells us that the stock will be in a momentum if the reported EPS is high than the expected EPS. The stock will rally. Okay. But if the stock is constantly beating the expectation, we also need to check the standard deviations. So what we do, this earning surprise which we got, okay, this earning surprise that we have here, this entire earning surprise, if I divide it by the standard deviation of the surprise, what is standard deviation of the surprise? So we take all the reported earnings, expected earnings, we calculate the difference, and we divided it by the average and the standard deviation. So we take the average of surprise and divide it by the standard deviation of the same. So I will do the standard deviation of surprise, right? That when I divide it by the standard deviation of surprise, this will tell me that whether the earning surprise is random or it is consistent, right? Do I want this ratio higher or lower, everyone? Higher or lower, correct? So that the market beating is meaningful, everyone. First of all, positive earning surprise, good. Earning surprise should be positive, fine. But when I say standardize unexpected earning surprise, if the earning surprise ratio is high, what is the conclusion? It relates to the error. Check out this. Higher the ratio, smaller is the size of forecasted earnings to the surprise. So if this ratio is high, everyone, and when will this ratio be high? When the standard deviation is low, isn't it? So if the standard deviation is low, if the standard deviation is low, the ratio will be high, and higher ratio means low error. Higher ratio means low error. Is this clear, everyone? Check, check, check. Perfect. Now, the last ratio or the last formula of this topic is weighted harmonic mean. Yes, weighted harmonic mean. A harmonic mean we have all calculated in level 1. Harmonic mean is where we take the inverse of the price in the denominator and on the numerator how many investments. Here weighted harmonic mean is actually used to analyze the the PE ratio of the components of index. So we want to calculate the P ratio of the entire index. So we take the weighted harmonic average of all the PE ratios of the stocks, right? So the total of weight is always 1. So in the numerator, it is always 1. And in the denominator, we take the weight of each stock multiplied with its P ratio. So we take the weight of each stock multiplied with its P ratio, and then we sum it up. So we take weight of 1 in multiply with not P ratio, sorry, my mistake. We divide it by P ratio, or we multiply with 1 over P ratio. I made a mistake. We do what? 1 over P ratio. So we take the weight, everyone, into 1 over PE ratio. 1 over P ratio. Very, very important. This becomes slightly technical. So we take the weights. We had done an example in the class. So what do? We take the weights based on how much is the investment and inverse of P ratio. Weight and inverse of P ratio. In level 1, when you did when you did harmonic mean, you took the inverse of price. Here I take inverse of the P ratio, but I multiply with the weights. This we will do for each security. The total of weight is always 100. So that's 1 on the numerator. Everyone clear with this? Yes. Check. Confirm. All good till this point? Any doubts? Correct? Yes. Yes. Let me know your question. ROE. Yes. What's your question, dear?
So, in the average
Mm.
ROE, we should
Mm.
multiply with the end value of BBPS, right? So,
Wait a minute. Average ROE, we should multiply with
end value of BBPS, you said at
the
zero.
recent value, not the forecasted. The recent book value per share.
Okay,
Book
but
value.
I
Mm.
solved
Mm.
some of the sums like that
Mm.
only.
Mm.
That's why I asked.
Mm. Yeah, tell me, what is the question? I didn't get it. Yes.
So that we will calculate multiple ROEs, right?
Yes. Yes.
Average ROEs and average book value, I mean, sorry, book value per share.
Yes. Yes. What
So
about
that
book value per share? Yes.
we will calculate, multiply with the end book value, not the beginning book
Mm.
value. It's
We
the
take the most recent book value. We take the most
Mhm.
recent book value to understand what is the normalized current year earnings. If you are forecasting, you can take the future book value. So here, what we do, the existing earnings that I have, I want to normalize that. So I will take the historical average ROE and the existing book value. If you are forecasting, you may take the future book value. So depending on where
Okay,
you're
sir.
calculating, if you are doing expected earnings, then you may have to use that year book value. Here, when I'm doing normalized earnings, I'm current earnings I'm adjusting. So what I will do, the historical average ROE I will take and multiply with the current book value. But again, if you're doing it for the future, you will take that period's book value. So let's say I have to calculate normalized earnings for next period. So then whatever is the average ROE that is provided to me into the forecasted book value. So book value depends on which period earnings you're calculating. Got it?
Okay, sir. Got
Right.
it. Got it.
All right. Yes. Any question? Anyone? Check, check, check. All good till this point? Okay. Yes. Now, the reading one was introduction about the process. Reading two was about dividend valuation models. Reading three, free cash flow. Reading four, market-based multiple. And now, reading five is about the residual income models. This is something that you had not studied in L1. All right. So let us discuss the formula about this model. Residual income. Residual income is economic income. It's not a net income from your financial statement. It is also called economic profit. Now, there are multiple ways of deriving it. One was EVA, economic value added, market value added. These are the two basic ones. And then the entire topic is about deriving residual income and valuing the company using that residual income. So, yes, EVA and MVA we will discuss, but the primary focus is going to be residual income and valuation using that, right? EVA, economic value added, economic value added, and MVA. All right. EVA. EVA is nothing but net operating profit minus the money that you need to pay to the investors. So we do net operating profit, that is EBIT into 1 minus tax rate. What is this called? Net operating profit minus what you need to pay to the capital providers. Your capital provider is nothing but total invested capital. Total invested capital is debt plus equity. You can either say debt plus equity or you can say working capital and fixed capital. What is total invested capital? Let me just write down EVA and MVA only here. Total invested capital into, I will first write it down, total invested capital into WACC. WACC is for the entire company, right? Weighted average cost of capital is for the entire company. Now here, when I say total invested capital, now institute can put across two ways to calculate total invested capital. It can either use debt and equity. So we use the book value of debt and equity. To be precise, we take the long-term debt and equity. So we take the book value of long-term debt and book value of equity. Remember, I'm taking book value, not the market value. Either we can do this or the other way is, see, book value of debt and equity is the source of fund allocation. Where do you use this fund? Working and fixed capital. So we can either do working capital and fixed capital depending on what information is provided by the institute. That will give us the total invested capital multiplied by with the WACC. That is your amount that you need to pay. Okay. Subtract that from the operating profit 1 minus T, which is called NOPAT, net operating profit after tax. Yes, EVA, clear everyone? Right? Good. Okay. MVA. MVA is market value added. It tells us the value added by the management. So MVA is pretty much simple. We compare the value of equity. We compare the value of equity. One, we take the market value and then we compare it with the book value. So we take the market value of equity and the difference between the market value and the book value. But it's not only the equity. When I say the market value of the entire firm, it will be what? Equity and debt. So we take the market value of equity and market value of debt. That itself is what we say the market value of the entire company, or simply said, market value. So when I say market value, I mean by the market value of debt and equity both, because we are seeing what is the value addition in the company. So we take the market value of the company and subtract the book value of the company. So subtract the book value. Book value is the balance sheet value. So in that case also we will take what? We will take the book value of debt and equity. So we will take the book value of equity plus the book value of debt. Debt. Are you with me on this? So the difference between both is due to the management's addition. This is what we use for MVA and EVA, market value added and economic value added. EVA is a yearly measure. MVA is a cumulative measure. Beginning value is to be used, sir, in EVA. See, in EVA, yes, we use the beginning value. And if you look at here in EVA, when I look at total invested capital into WAC, so when was it invested? At the start of the year. So when I say total invested capital, in that we use the beginning values. Yes, to just clarify, we use which values? Because you invested at the start of the year and you're trying to find how much is the return. Correct? But when we come to MVA, we are comparing what is the value of the company at the end of the period, the book value and market value, because market value is on the end of the period. So in that case, we take book values which are at the end of the period. End of the period. Here we take the end of the period. Okay. So in EVA, we take the beginning values, and in MVA, we take the end of the period value. Understood? Clear? That was the route, right? Perfect. Yes. I'll repeat. See, EVA is what? EVA tells you how much return you earned. So you take the beginning value. MVA is the value. What is the value as of now based on market and based on book? So that's why we take the end of the period value. The objective is different. That's why different book values, the beginning and ending. Got it? Clear? When to use which one? All right. Yes. Okay. In the notes also, if you will see, we have written here in the EVA, we take the beginning values, and in the MVA, you will notice we've taken the end values. You will notice here we take the end values and beginning value. Okay. Perfect. Yes. Now, EVA, MVA is important, yes, but not more than the actual residual income calculation. Throughout the syllabus, throughout this topic, our focus is going to be on the derivation of residual income. Residual income is for equity shareholders. The EVA, MVA are for the entire company. So residual income is basically how much is the earnings of the company. From that, we will pay to the shareholders. So what do we pay to the shareholders? Shareholders, we take the cost of equity is what we will pay on the invested amount. Now, in this case, we will take the book value, but book value of what? We will take the book value of, for residual income is for equity shareholders. So remember here, we will take the book value of, yes, book value of equity. Am I correct? Book value, that is the total equity value, right? So here we will multiply that with the book value. Again, the question would arise, should I take the beginning or should I take the end? Now for that, I will just cover up here. So imagine if you're calculating residual income for a specific year, let's say T. So earnings of that year minus how much the shareholders expected on their investment. So whenever you are trying to find a particular year's valuation, you will take the beginning book value, isn't it? Are you with me? Why beginning now understood and connected? Clear the route? Realize why I take the beginning value? Got it? Yes. This is your residual income model. Earnings, from that, we subtract equity charge. What is this component called? This component is called equity charge. That is how much the equity shareholders need or expect. All right. This, if you see in total terms, it is net income and total equity into cost of equity. I have converted everything into per share. So I will get residual income per share. There is another formula to calculate residual income for which I'm not going to do the derivation. We already know the derivation is that we will have ROE minus R. R is cost of equity. ROE minus R, everyone, the difference between both into the book value. Are you with me on this? This is the another formula. Again, the T and T minus 1 will be same. Both formula are critical. Both formula are critical. Both formula are critical. Everyone with me? This is how you will derive the residual income. You can check the residual income. We did the same in our class also, right? We can go into the derivation of that, is not needed. But two ways of deriving residual income. This residual income will now be replacing dividend or free cash flow. Now, in a typical Gordon's growth, how do we derive the value of the company? In a typical Gordon's growth, we derive value of the company D1 over R minus G, right? Here, instead of dividend, if I use this shortcut formula of residual income, ROE minus R into book value, right? And since we take the beginning book value, I will say B0, beginning book value. This will replace dividend, isn't it? This will replace dividend. And since it is constant growth rate model, we will do R minus G. However, remember, this is residual, extra. When I look at company's valuation, now the most important thing to understand in the residual income model is that the company's valuation is made up of two things. One is the existing book value plus the extra. Residual means extra. Correct? Everyone? This is nothing but single stage residual income valuation model. This is single stage residual income valuation model. Everyone understood this? Everyone? Very importantly, clear. What I did is that I just replaced the D1 with the residual income, R minus G divided by for constant, but we added the book value also. The book value also. Now the same thing, if I were to do justified, very important, I'm connecting this to the justified price to book value ratio. Justified price to book value ratio. If I say justified price to book value ratio, we understood there was a justified price to book value ratio, which also has a similar component, something similar to ROE, right? If you remember what is a justified price to book value ratio, let me go through that. Justified price to book value ratio, it is ROE minus G over R minus G. Remember this, ROE minus G over R minus G. Why am I discussing this? Let me come across that. Justified book value is ROE minus G and R, cost of equity minus G. It's a ratio of both. Now, why are we discussing this too? We are discussing this too because if you notice, if the ROE, that is the return on equity, minus R is the required, if they both are same, every in the class, then the justified price to book value ratio will be 1 and the company's value will be same as the existing book value, isn't it? Company's valuation should be same as the existing book value. So the company's value will be more if the ROE is greater than R. So what will create the value? To create the value, ROE should be greater than the R. Means the company's return on equity should be more than what the shareholders require. Only then the valuation will be above. If this is the case, then what happens? The value of the company V0, if this is the case, value of the company will be greater than V0. Are you with me? Have you understood this? Important, right? Critical, right? Check. Got the connection, everyone? Right? All right. So we just did the single stage residual income model. You can use that for multi-stage also. In multi-stage residual income model, we will calculate, first of all, we will always have the book value, right? And then we will add the expected residual income. I will now discuss about that multi-stage residual income. Multi-stage stage residual income valuation model. Okay, very, very important. In this, we are trying to derive what? V0 or V0. Same process as constant growth rate model. And then we expanded multi-stage model. So here V0 will be equal to B0. Remember, this makes the model more reliable because majority of the component is real, not estimated. Correct? In Gordon's growth, majority of the value is at the end, terminal value. Now, if it is multi-stage, there will be two more components, high growth phase and constant growth phase. So we will calculate the present value of residual income, which is called as expected residual income. So we say present value of expected residual income. This is during the high growth phase. During high growth phase, right? And then comes the third component. The third component is called present value of continuous residual income. This is like terminal value. Continuous residual income. It is similar to terminal value that you did in the the Gordon's growth model. Now, present value of in order to calculate this present value of continuous residual income, how is this derived? To derive this, we use a persistent factor. And what is that persistent factor, guys? That persistent factor, it's all in our notes described and we have done it. That persistent factor will give me the residual income divided by 1. We do discounting. So we do 1 plus R minus W. Is this clear? 1 plus R minus W. That will give me the terminal value. Let's say it is after 3 years. So that will give me third year value. All of that discounted to present value. Understood? So now it has three components. The existing book value, let's say similar to 3-year dividend, we'll have 3-year expected residual income, and then we will have the terminal value. The terminal value is called present value of continuous residual income, which is nothing but this. And here the W is the persistent factor, which ranges from 0 to 1. Is this clear to all? Check, 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 check. So if it's a 3-year model, I will do what? I will do V0 equals to B0 plus residual income for 1 year, 2 year, 3 year, and like D1, D2, D3. And I will add what? I will add present value of continuous residual income in which period? Again, like terminal value, third year, third year. All of this will be discounted using the cost of equity because this is for equity, right? So we will discount this with 1 plus R for year 1, 1 plus R for year 2, year 3, and this will also be in year 3. This will also be in year 3. Everyone understood this? Check and confirm. Clear? Very, very, very important. This part. This part. Anyone has any doubt? Got it? There are actually W can be extreme and 0, 1 or between both. 0, 1 or between both. I will discuss that 0, 1 or between both. Where is that persistent factor? See, check here. This is the persistent factor. It will be between 0 and 1. That will give me present value of continuing residual income. They will provide you with what is the persistent factor. But just for your simple understanding, we did the same thing in the class. If you notice, there is one more component, the long-term average. What if instead of telling a particular number, they give us the information that what if the persistent factor that the company's growth rate will decline to a long-term average. In that case, the calculation of terminal value is slightly tricky. What we do is that we take the difference between the book value and the book value that and the price or the value of the company. We take the difference between the value of the company, same like MBA. In MBA, what we did, we took the market value and book value difference. Same year, we take the market value and book value difference. That difference between the market and the book value will be considered as my additional value. So market value minus book value plus, let's say if it is till third year, so that third year's residual income. So that is one twist. In case if they say long-term average, we will just simply take the market value and the book value. Remember, market value and book value in the future. So they both are estimated. That T year stands for terminal year. Estimated based on the price to book value ratio and the carrying value based on balance sheet. So one is an estimate, both are estimated by the way, but one is based on valuation, the other is based on the financial statements. That difference, don't worry, the institute will provide you with all this information. That is the twist in case if they say long-term average. So here I will either do this if they provide me persistent factor, or I will use the long-term average. That is book value based on forecasted and the actual book value. I mean the forecasted book value based on financial statement. This makes it slightly tricky, but that difference between the both, like MVA, market value added, forecasted value using formula, and the financial value, this two value will be provided. That will become your terminal value in case if they use what, instead of persistent factor, if they say the growth falls to long term average. Rarely tested, but we've discussed it here. Understood? Most of the times they will say the persistent factor in this way that they will say that the growth rate will become zero. Yes, just a moment. In case if they will say that the growth will persist, if they say persist means W is 1, then this becomes constant. If they say the growth rate will drop immediately to zero, then W will be zero. If they say it will decline to zero, then they will give me a persistent factor of 0.3, 0.4, or 0.5 something. But if they tell me to no, it's a long-term average, then I will take that particular period's price and that particular period's book value. Again, remember the PT year. What does the PT stand for? PT stands for the book value at that period multiplied with the forecasted price to book value ratio. That will give me the market value of the company based on forecasted, and I will subtract that with the book value of the company. Both should be provided to us. Yes, there is a question. Go ahead.
In this, do we
Yes.
add,
Hmm.
like, do we just use the PT minus BT value, or
Correct.
do we use it how is it given in the notes here? That is adding RI, dividing that by 1 plus 1.
RI, see, RI is what? We add that RI because last year there will be some residual income, right? So here, what I will do, I will take residual income, and here you see present value of continuous residual income.
Yeah.
Instead of that, I will do PT minus BT. So
Okay, got
again,
it.
I will not add RI, but that is the difference in the valuation. So in the last year, we always have two values, right? So we have two
Yeah.
values in the last year always. We have that year's residual income and the terminal value. So just to clarify in the class, I had written it that in the last year, you'll have two values. The present value of continuous residual income and the last year's residual income, both will be discounted to the present value. Understood? Right?
Yes.
So together, if you separate them, the only difference here is that this will be replaced with either the persistent factor or PT minus BT. PT is forecasted using the price to book value formula. Very complicated. We had done one vignette in the class based on this. So that is where the only difference is of that terminal value. How is that derived? Got it?
Okay.
Yes.
You have discounted the present value of CRI also.
Correct,
Which one
because
present value of CRI?
it's in that period. Because we are forecasting what? Residual income, and beyond that period, what will be the forecasted continuous residual income? So at the end of the day, everything should come back to the present. Got it?
Okay.
Yes. That is after 3 years, 4 years, 5 years in a multi-stage model. So that T year is terminal year. In my example year, I put the terminal year in third year. All good? Perfect. Now, in this topic, one last concept which is actually repeated in FSA and corporate issuer also is clean surplus. Do you know what is clean surplus, everyone? Clean surplus. Clean surplus is the difference between the retained earnings or the difference between the actual book value of the company should be due to net income and dividends, isn't it? So if I take the difference between the ending values, book value of equity is nothing but the total equity value on the balance sheet between the last period and this period. What should be the difference between both due to? The difference between both, yes. What is the clean surplus formula? Anyone? We take the beginning value, right? Everyone, beginning book value and the ending book value of the company. It should be because of net income and dividend only. So if I take beginning book value plus if I take net income minus any dividend paid should be equal to the ending book value of the company. This is what the equation should be. But if it does not match, then we say clean surplus violation, and that violation is due to OCI. That violation is due to that income and expense which bypasses the net income. Understood, everyone? So clean surplus is this if they match. If they don't match, it is clean surplus violation because, yes, as rightly said, it bypasses the income statement, goes into OCI. This is what we discussed in pension also, in FSA and various other places where there is OCI coming up. So then clean surplus will be violated. Residual income has this problem because we are valuing based on companies, all these financials. So we assume they match. All right. Yes. Now we will discuss, this is residual income, too many formulas. Now we will move on to the last topic here where we have very few formulas, that is about private company valuation. In private company valuation, the model of valuation we use are somewhat similar only. But here, the most important thing is that we need to adjust the earnings. So, the earnings that were provided to us, we adjusted those earnings. So, that is what we call as normalized earnings. Remember, here, the normalized earnings require, there's no formula for it, but I'm just writing it down. Normalized earnings are adjustment into earnings if the company were acquired. So it is earnings, and I'm right, it's not a formula, I'm just writing it down. Plus or minus, that adjustment can be plus or minus based on the adjustments if the company was acquired. Adjustments if company was acquired. Now I'll repeat, there is no formula for this. So you will be probably given an exam that the owner overpaid salary to himself. So you will have to readjust that. You know, you had utilized the money for your own self. So you will readjust that. All of that adjustment for owner related transaction will help us derive the normalized earnings for private company. I'll repeat, normalized company for private company, you have to do manual adjustments based on the concepts that we discussed. To calculate the cost of equity for private company, we can use a simple CAPM model, but that is not reliable because private companies details are not available. Normal CAPM model we all know, where we use what? Where we use expected return or cost of equity based on RF plus RM minus RF into the beta of equity. Now the entire question was about how the beta of equity can be derived for a unlisted or a private company. So in this case, we calculated beta unlevered and beta levered. If you remember, beta unlevered, and then we calculated beta levered. So we take a reference of a proxy company, right? And we lever unlever the beta, means we adjust for the debt equity. So let's say a company from the same industry, we take its asset beta or unlevered beta. Unlevered beta is called the asset beta, and that beta we adjust. So how do we get the asset beta? Imagine a proxy company which is listed. We take its equity beta, ever in the class, right? And we unlever it. Unlever it. So how do we unlever it? Yes, we divide it by the debt equity ratio of that company. If there is a tax, we adjust tax with the debt, right? We always adjust tax with the debt, not with the equity, isn't it? So this adjustment will do what? It will remove the effect of leverage and tax both from the publicly listed company's equity beta. Now it is called unlevered. Unlevered. Once we get the unlevered beta, that unlevered beta, or I will say unlevered beta, I'm writing short form, unlevered beta. In that, we will adjust our company that we are trying to value, our company's leverage. So how will I adjust the leverage? Again, 1 plus debt equity ratio for the tax, adjusted for the tax. But now this debt equity ratio is it of the industry or our own company? It is for our company. Let's say our company, I name it as X, CAPM for X. So this is debt equity ratio and tax of X. And this is for the peer company. Sorry. All of this is for the peer company. Understood, everyone? I don't expect this higher end of calculation, but my job is to tell you what the formula is. So first step is what? First step is we will calculate unlever beta, means from the equity beta of the peer company, we will adjust for the taxes and leverage. Then the second step is calculating the levered beta for our company X. That is going to be your equity beta. So we multiply with our company's 1 plus debt equity ratio. Everyone understood this? This is the adjustment in CAPM for cost of equity for private company. Otherwise, we cannot get the CAPM for a unlisted company. Understood, everyone? This components, check and confirm. I will also show you where in our notes this is everywhere. Everyone check, check, check. Unlevered private companies beta adjusted. Yes, this is just how we will derive the CAPM. In CAPM, remember, beta equity we don't have for our unlisted company. So we take a proxy company's beta, adjusted for leverage. Got it? Have you written this, everyone? All right. Now there are two more variants, everyone. I hope you guys are writing, right? Two more variant. One is expanded CAPM, and then there is build up CAPM. You must have seen this coming up again later on. Expanded and build up CAPM. Expanded CAPM and build up CAPM. These adjustments are required in CAPM for the private companies. So here we will derive the cost of equity using what? Cost of equity or expected return. Yes. Anybody would like to guess? We always start with risk-free, risk-free, risk-free plus risk premium. Yes. Now risk premium is RM minus RF. RM minus RF into the beta of equity. But your question will be that, sir, the company is not listed. So how will we get the beta of equity? So this is where we will use the two unique approaches. We will take beta of either the industry or the broader index, or we will do what? We will take the beta of a peer company. Yes, the two beta adjustments that we are going to do, we will take these two beta adjustments to derive the expanded CAPM, and we will understand the build-up method. In both cases, we will try to understand how to derive the expected return. Yes, anyone would like to guess what will go into the expanded CAPM? Yes, expanded CAPM. Anybody? Check. We do what? Risk-free plus,
Risk premium.
yes, risk premium, that is equity risk premium into beta of equity. But this is which beta, everyone in the class? This is for the peer company, isn't it? So we take a peer company's beta, a peer company's beta. Now, whenever I'm taking peer company's beta, again, it's not same as my company because this company is listed. So our company is not listed. So we always adjust for this by adding two premium: size risk premium and company specific risk premium. Company specific risk premium, which is also called unsystematic risk, isn't it? So we adjust for size and company specific risk premium, or you can say unsystematic risk premium. Is this clear? The two risk premium that we adjust, company specific or unsystematic risk premium. Clear, everyone? Whatever you name it. Now, in the build-up CAPM model, what we do is that we take the expected risk premium, yes, that is RM minus RF of the industry, or a company which is large cap, basically any large cap company. Remember, large cap companies beta is close to 1. So we don't multiply that with beta. We take the large cap company, right? Maybe because it's a new business. So large cap companies beta, and again, large cap companies risk premium, we don't multiply with any specific beta, but we say large cap companies beta is close to 1. So ideally, you can say multiply with beta, but no need to do that. We just say it is 1. Plus, we will add for the same risk premium. We will add for size risk premium also, and unsystematic risk or company specific risk premium, CSRP, whatever you call it, company specific risk premium. However, since I've taken a large cap company, which is not from my industry, so therefore, industry risk premium is added separately. Understood this? Everyone in the class? Clear? Industry risk premium is added separately. Clear why? Got it? Yes. Everyone written? Perfect. Yes. Now, in this topic, there are two amazing discount for lack of control and lack of marketability. Listed companies have this issue. So I will write down both the discounting. We first write down for discount for lack of control, and we don't calculate separately discount for lack of marketability. We rather calculate the combined effect, that is the total discount. Total discount. So DLOC and total discount. So when I calculate the total discount, we will discuss both the discounts. Everyone, very important formula. Discount for lack of control, there is a complicated formula, that is 1 minus 1 over 1 plus control premium. 1 over 1 plus control premium. This is one formula, but to our students, I had given a shortcut formula also. Do you remember the shortcut formula, everyone? It's difficult to remember, but the easiest way is take the control premium and divide it by 1 plus control premium. 1 plus control premium. That's the easiest way to remember. I recommend you guys use this. It's easy. Control premium over 1 plus control premium. That will give you discount for lack of control. But if you want to adjust for both the discount, that formula is very interesting, highly testable because of its uniqueness. That is, you will take 1 minus discount for lack of control into 1 minus discount for lack of marketability. Both will be provided to you, and all of this you will subtract from 1. This formula, unique formula, highly testable as per me. Got it? Everyone in the class? Clear? Written? Cool? Yes. Okay. Now, in private company, when we value the company in private company, the valuation uses the income approach, where we use the same method of valuation which we did already in the previous topic, free cash flow method or capitalized cash flow method. Remember the capitalized cash flow method or free cash flow method? It's not the same. You're just calculating value of the firm using the same concept that you did before. So if they ask me capitalized cash flow method in case of valuation of private company, so I will calculate valuation of private company using capitalized cash flow method. I'll repeat, it is nothing different. It is same as what you did in your FCFF concept. So we value the entire company using first FCFF, then we find the value of equity. All right. So we do the same thing we do the FCFF. I'm using the constant growth over WAC minus G. Sorry, WAC minus D. This will give me value of firm. From this, I will derive the value of equity. So first we will do this. Then we can also derive directly value of equity using the same concept. We can do using FCFE, expected over WAC minus G, RE minus G. I missed out here. Here also we should write expected. Okay, sorry. All good. This is same, nothing different. There is a unique thing here which is something like a trouble for many student, is valuation using what, a very unique thing called excess earnings method. This is simple. Excess earnings method. What is excess earnings method? Excess earning method breaks down the company's valuation into 3 components. Yes, so we are now going to value the company using excess earnings method. Excess earnings method, right? Under this case, we are going to calculate value of firm, which is equal to what? 3 things: value of working capital, fixed capital, and the last component is intangible assets. So we do here value of working capital plus value of fixed capital. This will be provided to you. They'll be providing you the total amount of working and fixed capital. The third component is unique. What is the third component? Plus we say value of intangibles or value of intangible asset. Now, this is something that you may not have derived in the past. So what is value of intangible asset, everyone? Similar to Gordon's growth. So what we do, we take the excess earnings like residual income. We take the excess earnings. So instead of dividend, what do we do to find the constant model? D0 into 1 plus G over R minus G, right? Now, instead of D0, what I have done is that I have taken the excess earning. Excess earning is similar to residual income. Extra that the company will generate over and above the net income. From the net income, what we are going to do, net income here, I will say normalized. Okay. So instead of just writing net income, I will rather write normalized earnings, because in private company we always don't take the net income as it is, we adjust. So we take the normalized earnings. From that, imagine if you had to calculate the residual income, what will you subtract? You will subtract the required rate of return on equity into the total invested capital, which we generally here use fixed capital plus working capital. Why do we not use the market value, the value of debt and equity, because it is not listed. So here they will generally provide you fixed and working capital, multiply that with cost of equity. That is how you derive the excess earnings. Excess earnings using the constant growth rate model, that is value of intangible. This is the unique way of valuation in private company. Okay, we have used the single stage model only. This is the unique method of valuing the private company. This is, according to me, a bit critical because it is new. All good, everyone? That's it. In terms of formula, the other methods are based on the availability of data, because when I say guideline public company method, transaction method, the only difference between both is adjustment of control premium. When I take the transactions, control premium is already adjusted. When I take the public company method, it is not adjusted. This concept is repeated again in corporate issuers also. Everyone, clear? Clear? This is where we cover massive formulas of equity. Equity has one of the highest formulas. I've tried to cover almost all of them, hopefully. Yes, got it, everyone? Clear? Yes. Now, similar to equity investments, fixed income also has a 10 to 15% weightage. 5 readings only you have, but the topics have much more depth in terms of concepts compared to level 1. Formula may not justify everything here. The formulas may be relatively lesser, but the concepts are much wider. Okay. Although you don't need to memorize most of the formulas, but some formulas are very critical. Okay. So we will start with the first reading, which was about the term structure. This reading had formulas related to spreads and related to the basic spot forward formulas. Okay. The expectation theory. So whenever the first thing about reading number 1, we used to derive something called as the discounting factor. Discounting factor is a factor for a zero coupon bond. So I'll move to, after equity, we will move to fixed income. Where is fixed income? Fixed income, yes. This is where fixed income is. The first thing that we had is the discounting factor formula. Discounting factor is a zero coupon bond value factor. So to calculate this, discounting factor 1 plus the discounting rate for 1 year spot rate. So we take 1 year spot rate to the power 1. If it's 2 year, we take to the power 2. So actually it is st depending on whatever the period of spot rate it is, and to the power t. That will give me the discounting factor for that particular period. Okay. Remember, this discounting factor is used to derive the spot and forward rates. Spot and forward, which you also did in level 1. Here we are going to derive spot and forward using a pure expectation theory. So the most important thing is how to derive the forward rates. Forward rates. Forward rates. Let's say F11. Okay, it's not something, a formula that you have to memorize. What is F11? It is 1 year forward after 1 year. So for this, I require two things: spot rate for 1 year and spot rate for 1 year. Wait a minute. To derive this, I will take spot rate for 1 year, multiply that with what I need to find. Multiply that with 1 year forward rate after 1 year should be equal to 2 year spot rate, but to the power 2. To the power 2. Clear, everyone? Similarly, if I have to find forward for, now remember, we always read from right to left. Even though we write it from left to right, this concept, if you remember the technique, we read it from right to left. So if I want to find 2 year forward after 1 year, what will be the equation? 2 year forward after 1 year. So I need 1 year spot rate, yes or no? Correct? Into 2 year forward after 1 year. This is 2 years. So to the power, I will do what? To the power 2 should be equal to 3 year spot rate. Everyone clear with this? So it's not something that you have to remember as a formula, but you should know how to derive the forward rates. Got it? Everyone, this is how we derive the spot and forward rates. Any questions here? All right. Now there is a concept where we derive the spot rates using the par rates. What is that concept called as? That concept is called bootstrapping. Bootstrapping is a process where, again, there's no formula here, but I will write down how we did it. Where we were given par rate, and from that par rate, we derived the spot rate. Remember, a par bonds coupon and yield is same, correct? So the par bond eventually should give me its market value should be equal to the face value of the bond, correct? That is the par value. So if I want to find a spot rate for let's say 2 years, so I will require a 2 year par rate. So let's say that par rate is given to me as 4%. So I will take par rate for year one, par rate for year two. This is 2 year rate, everyone, and we will discount them. But remember, a par bond will eventually pay me, or any bond will eventually pay me FV. That FV is nothing but par. Let's assume it is 100 only. All of this, when discounted using the spot rate, should give you how much? Should give you par only. Now, the spot rate, which helps you derive this, the spot rate 1 plus S2 to the power 2 is going to be your par rate. So initially, you will first find 1 year spot rate and par rate is same. Remember, 1 year and, are you with me? 1 year spot rate and par rate. S1 is equal to par rate for year one. They both are same. Second year, you will find using this method of trial and error. Are you with me on this? Everyone clear? Again, there's no formula here, but this is how you will do the bootstrapping process. Bootstrapping will help you derive the spot rates from the par rates. And then there was a concept called realized returns. Realized returns are also called horizon yield or horizon yield. This is the returns which are not same as YTM. When you hold the bond not before maturity, you may sell the bond before maturity. So you need to find the realized return. Remember, the realized return is nothing but holding period return, where you will take the ending value over the beginning value minus 1. And if it is for more than one period, you will compound it. Let's say for this is for 5 years. So what I will do, I will take a geometric mean of it, 1 divided by n or t, right? This is what you will calculate. So before, if it's single period, you will do this. If it's compounded, you will use this. It is actually what we calculated in the class where we derived the realized returns. Let me show you how we derived the realized return. We took the present value. We took the what first from bootstrapping process. We converted the par rate to the spot rate, and then we calculated the holding period return for each period. In this way, we calculated only for one period, so we didn't have to do to the power 1 over n or 1 over time. But if it is for multiple period, you adjust that. Okay, so you take the ending and the beginning price, right? If there is coupon, you add the coupon also. Okay, if there is coupon, you add the coupon. So it is ending value over the beginning value to the power 1 over t if it is for more than 1 year. If it is not, then 1 over t is not needed. T year is your holding period. It may be 1 year, 2 year, etc. That is how you derive the realized returns. Okay, if you know the concept, you will be able to apply it. It's not a new formula. Got it, everyone? Yes. This is rarely used, but it is very critical. Okay. Now, the other formula was related to, now, if we go in the order of the topic, the other formula, the important concept was rolling down the yield curve. And then there were the different types of spread. Everyone remembers the spread, different types of spread. I will put up the name and you can let me know if you know the formula, because the name itself is the answer here. So the G spread and I spread we already discussed in L1. Here I spread will come up, but there are different types of spread. I will write down all the spreads. Swap spread. Yes, you have similar to that I spread, interpolated spread. Then there are some unique spreads, which is TED spread. TED spread and TED, TED spread. And then a very famous MRR OIS spread. These four spreads are something new for you in L2. Z spread and option adjusted spread is something that you discovered in L1 also. So I will write Z spread and option adjusted spread. I'm actually putting all the spreads here. Correct? Spread is the difference between the yield of two bonds. So in a swap spread, guys, what are the components in a swap spread? We take the swap rate. The name itself is the answer. Swap rate, interbank rate minus, what is the benchmark that we take? Treasury. Minus we take the treasury yield. Okay. We take the treasury yield. Very important, these formulas. Okay. In I spread, one difference we do is that here we take the riskiness of our bond and compare with the swap rate. So we compare with the swap rate and we take the yield on a risky bond. Okay, that is our bond of comparison here. A corporate bond, we compare with the swap rate. TED, TED, TED is Treasury Euro Dollar. So it has treasuries into it. So this is MRR, market reference rate, minus, as the name says, treasury. So we take the T-bills rate. T-bills is long term or short term, guys? T-bills is short term. So this all focuses on the liquidity risk or the credit risk in the banking sector. Similar to that is MRR OIS spread. The name itself is the answer. So it is MRR OIS, overnight interest swaps. Overnight interest swaps. They both are used to analyze the banking sector risk. Clear, everyone? Swap spread, I spread, TED spread. TED spread, as per me, is very famous. For your exam point of view, I'm saying MRR minus T-bills. MRR is market reference rate. In the past, we use LIBOR. So this is very critical. And Z spread, OS, I will discuss. But everyone clear with this four spread? Now, Z spread is not actually as a formula, but what we do is that when we discount a bond, how do we discount the present value of the bond, guys? How do we discount? Let's say if I want to find a present value of the bond, I will take coupon, let's say 3 years plus face value. And we discount generally with the risk-free rate or the spot rate. Remember, risk-free rate is a spot rate. So we take 1 year spot rate, we take 2 year spot rate, we take 3 year spot rate and to the power. But what if along with that, I add a constant spread, that constant spread when added and then compounded. Okay. So we will compound after adding that constant spread, which is actually derived using a trial and error method. Then that becomes Z spread. So Z spread is the constant spread over the yield curve. Now, I don't want to go too much depth because this is just a formula session and I know don't want to waste your time, but everyone knows the Z spread. Z spread. So this is my spot curve. And for a corporate bond, the curve is exactly parallel on the upper side. So that extra difference is what we call as the Z spread. Let's say it is 20 basis point. So when we find the present value of the bond using the spot rate, that is for a risk-free bond. But when we add 20 basis point to each of the spot rate, it will become parallel. Got it, everyone? OAS, option adjusted spread, is generally used for callable and puttable bonds. Here, OAS for a callable bond. For a callable bond, is the spread higher or option adjusted spread is higher? For a callable bond, the spread is higher because it will take credit risk and the call risk. So from the callable bonds Z spread, if I subtract the call option value, then I will get the option adjusted spread. Is this clear to the class? Everyone, check confirm, check confirm, check confirm. Right? Interesting, right? Till this point. All right. Yes. Now we'll focus on the duration. Duration is also there, right? Remember the duration that we need. What are the types of duration that we discuss? We discuss effective duration. We discuss other types, effective convexity, effective duration and effective convexity calculation will come up. But in this specific topic, we discuss the key rate duration also, although key rate duration is discussed later on. So all the three durations, effective, key rate, and convexity related concepts, we will discuss it when we do the duration discussion. Here, one very interesting model is we find the change in the bond price due to not only change in the duration, but we also find change in the bond price due to the other factors. What are the other factors? That is the level, steepness, and curvature. Everyone remembers level, steepness, and curvature. This formula is very, very important. Yes, even though it may not be tested in terms of calculation, but you should know we are deriving the change in the price of the bond. Change in the price of the bond is change in price over price, which will give me percentage change in price of the bond. So if I want to find the percentage change in price of the bond, normally until now we used to only take the duration, that is the sensitivity to the level of interest rates. But now we take steepness and curvature also. So again, I'm repeating, this may not be tested in terms of calculation, but you should know it is duration due to S. Your S duration, that is a sensitivity, right? Modified or approximate duration. This duration is multiplied with the factor, and the factors are three factors. It is x for what? Change in three things. What are the three things? Level, steepness, and curvature. So you will notice it is always this change in, I will write down duration, change in. The only difference that I will put across here is due to what? Due to what? So we will write due to three things. Due to level, so we write XL, due to steepness, and due to curvature. I will repeat, you don't have to worry this in case of calculation being tested, but you should know that now the sensitivity is only not related to duration, but also due to steepness and curvature. Is this clear? From the formula point of view, very important, right? Normally what we did before, I will tell you, first when we calculate change in price of the bond, we actually did what? We did modified duration into percentage change in yield or spread, correct? And this was one point. The second point was due to convexity, that is half into convexity into percentage change in yield square. This is something that you did in level 1. Is this clear, everyone? In level 2, rather than testing this, they will test you on the concepts more. Got it, everyone? This is where we complete our first topic. First topic. Now I will hunt for the formulas in our second reading. The second reading and the third reading was about backward induction. If you remember, in backward induction, we did the binomial model, everyone, the arbitrage free valuation. Under this, we do the backward induction. So we try to find the present value from the backside, right? Here, very important is one formula in the binomial is what is the distance between the interest rates, how to derive the forward when the rate goes up if the down rate is given to you. When the down rate is given, how to find the rate up. So basically, how to derive the adjacent interest rate under the lattice structure. Everyone remembers the lattice structure, right? So under the lattice structure, we will now move to reading number 2. How to derive the adjacent rates in the binomial structure. Okay. So what is the distance between both, everyone? The distance between, let's say I want to find the interest rate after 1 year, when the rate is lower. So you can go from lower to higher. The difference between interest rates, if I take interest rates after 1 year, the difference between lower to higher is very important due to the factor which is how many standard deviation, which is exponential of e to the power of 2 standard deviation. Are you with me on this, everyone? Clear? Very important. So if they've given you lower rate as 5% and standard deviation is provided to you, to 2 standard deviation continuous compounding, you will find the up rate. That is the rate on if the market rate goes up, what should be the rate? This is the formula that you should remember. The spot forward formula you already know. Anyone has any doubt in this? Check, check, check. All right. Yes. Anyone? Any questions? Now, in this topic, there were no unique formulas apart from the one which is a trouble for many students, that is the term structure models. Now, first, let me tell you, do I have to memorize this formula? No. I will write down the formula, but let me tell you, these formulas, you do not need to memorize it. You have to perhaps understand that what is the difference between the model. There are two models here. We do a term structure model, actually four models, but divided into two category. These are all, by the way, interest rate models. So these models are divided into two: equilibrium term structure and arbitrage free model. They have the formula. Okay, so I'm writing down the formula: equilibrium term structure models. Okay, and then arbitrage free term structure model. Arbitrage free term structure model. I am writing down the formula, but let me tell you, very straightforward. No need to memorize, need to understand the difference. The first name is Cox Ingersoll Ross model. Cox Ingersoll or Sol, I don't know. Cox Ingersoll Ross model. And the second one, you should know the name, the Vasicek model. The Vasicek model or Vasicek model. I don't know the pronunciation also. Neither do I care. Understood? These two models are the equilibrium term structure models, and the arbitrage free models are two. The simplest one that I remember is always Holy model. Holy model. And then KWF model, short form is what we call it's. You can read the name Cataway, Williams, Fabossi. It is KWF model. That is what I would suggest you to remember. All right, KWF model. Now, all of these models are going to predict the changes in short-term rates. So that short-term rate is what we call DRT, 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 DRT. Do not be in any pressure. The only reason we are doing this is to understand the model. Now, all the four models will derive me short-term rates. The only difference is in the KWF model where we do the log. Yes, we take the log of this. That is the difference. Everyone, check out here. All of this model, in this model, we take the log. Right? We are forecasting the short-term rates. Short-term rates. Now, here there are components A, that is the speed. You will notice the speed. A is speed, B minus R. What is B minus R? Long run value of short-term rates, and R is a short-term rate. So long-term average, and of short-term rates, and R is a short-term rates into T. dt is a small increase in time. dt, increase in time. Okay. That is what we call the drift. The drift. And then the change is in the component. So if you notice this component is similar, I will also write the same. You will again in exam, my suggestion, no need to memorize it. So it is A into B minus R, A into B minus R. That is common under both the models. Your focus should be what is the change. This is the drift component. The, the second point is the random component. That is dependent on standard deviation into a small random walk movement. So we do standard deviation. You will notice standard deviation. I have taken your population. You can actually take sample S into the dz. What is the dz? Dz is nothing but a small random walk movement. Again, don't get stressed. So you will notice dz is common. The only difference between the two model is very, very critical now is we multiply this with change in R. So in exam also your focus should be the Cox-Ingerson model is affected with R. R is the rate. Vasicek model is not, right? So you will see any volatility in interest rate, which will affect which model? Cox-Ingerson. Vasicek model is not affected by volatility in interest rates. All good? Holian KWF model, you will notice it is based on this theta, which is time drift into the short-term interest rate. And then you will notice everything else is same. There is no difference in the model at all. It's just that in the KWF model, we take the log value. Okay. Otherwise, the model has no difference in terms of formula. You want, you can write it. You don't want to write, that's okay. I don't want you guys to be stressed with this formula. Do not even put too much of an effort into this formula. It's a time drift. We call it as time drift. Time drift multiplied with the small increase in time. That small increase in time is called dt. dt, that is a small increase in time. Plus, we again take the risk here. The risk is standard deviation into dz. That dz, remember that dz is nothing but that's a small random walk movement. There's no difference in the formula here except the interest rate and here except the log values. These two models are single factor models. There is another model called Gauss plus. There is no formula for Gauss plus. Everyone clear? This I have clearly, I'm writing the formula, but let me tell you, you only need to know the difference. Okay? Everyone? All good? Right? Now, we move to reading number 3. Remember, reading number 3 was all about embedded option, callable and puttable bonds. So we compare the 3 bonds, callable bond, puttable bond, and straight bond. Straight bond. Straight bond is the value of bond discounted at the respective spot rate. It is non-callable, non-puttable bond, right? So straight bond doesn't have a formula. It is a simple present value using the future expected cash flows, right? Present value of the bond using future expected cash flows, right? Simple, discounted at spot rates. Callable and puttable bond, yes. What is the difference? Which bond's valuation is higher, callable or puttable compared to straight bond? Everyone in the class? Compared to straight bond, it is the puttable bond whose valuation is higher. Online, guys, are you there with me? Available? Hello? To keep checking. So the difference between callable and puttable bonds, straight bond is between both. The highest is puttable bond. So the difference between puttable bond and the straight bond, the difference between puttable and straight bond is called value of put. So what I will do is that if I have the value of straight bond, value of straight bond as B, value of straight bond, whose valuation is higher compared to in a callable bond? The callable bond, the straight bond's value is higher, isn't it? Straight bond value. From that, I will have to subtract the value of call. From that, I will have to subtract the value of call. Then I get a callable bond value. But in the value of straight bond, I will add back the value of put. I will add the value of put. Understood, everyone? In exam, they may ask you what is value of call or value of put. You will have to rearrange the formula. Okay, so simply said, if asked to me what is the value of call option, value of put option, I know in value of call, value of straight bond is higher than value of a callable bond. So the difference between both is due to value of call. Correct? In put case, the value of puttable bond is higher than straight bond. So the difference between both is value of put. Everyone clear with this? Any doubt in this case? Check, check, check. We did the backward induction for the embedded bond, just that we always tested whether the option will be exercised or not, and only then we derive the valuation. In the callable bond and puttable bond is what I will require option adjusted spread is what we discuss. Option adjusted spread. Option adjusted spread I discussed in the previous topic, but here is what we use. Option adjusted spread is used in this topic. And in order to measure the sensitivity, here we derive two duration, that is effective duration, duration and effective convexity using approximate formula that we did in level 1. So we take the difference between the price of the bond when the yield is decreased and when the yield is increased. So it is the bond value when the yield is decreased, I call PV minus, and bond value when the yield is increased. Remember, this will always be positive because the upside is more than downside. Correct, everyone? This will be always positive generally, but for callable bond, I would like to see how it goes. Divided by the, because we are taking the average, so we will take 2 into PV0 into, if it's an approximate convexity, we take change in YTM, but if it is effective, if it is approximate duration, we take change in YTM. But if it is effective duration, we take change in yield curve. Correct? Curve. Effective convexity, PV minus plus PV plus minus 2 PV0. PV0. Okay. Divided by PV0 into yes, percentage change in yield curve, yield, or simply yield curve. I will say what? Change in yield curve. Yield curve is always in percentage square. I will have to do square, square, square. Why? Because convexity is second order derivative. Second order derivative, like gamma. Got it, everyone? Yes. These are the formulas: effective duration, effective convexity, which are very important from your exam point of view in respect to this topic. Okay. Then concepts are too many in that topic. What happens to a callable bond? Callable bonds have negative convexity at lower yield and so on. Now, if you remember in that topic, most of the other formulas are related to an interesting concept, that is which topic? That is convertible bonds. I'm sure you must have encountered too many formulas related to convertible bonds, isn't it? Convertible bonds. So I'm going to put across all the convertible bond formulas. There are approximately 10, 12 formulas related to convertible bonds. Everyone with me? Convertible bonds? Yes. Now, either they will provide you conversion ratio or conversion price. So first of all, I will calculate conversion price, the first ratio. Very important. It tells you the price at which the bond will be converted. So we take here the bond's price. So we take the bond's price and divide it by the conversion ratio. Everyone, divided by the conversion ratio. Now remember, either they will give you conversion ratio so you can find conversion price, or they will provide you with conversion price for you to get the conversion ratio, vice versa. All right, everyone. Now, conversion price and then there is conversion value. Similar. Conversion value is basically dependent on how many shares you will get on conversion. So it is conversion ratio. I will take conversion ratio, the short form here, into the current market price of stock of the company. Current market price, remember, you should not be confused between market price of bond and market price of equity. So we write current market price of stock. These two formulas, everyone clear? Conversion ratio or conversion price and then conversion value. Now, remember, what is the minimum value of convertible? Minimum convertible value. Always remember the convertible bond will pay you at least a minimum amount that is equal to the straight value of the bond or the conversion value of the bond. So it will pay you straight value or conversion value. Conversion value we already know. What is straight value, guys? Straight value is, imagine if the bond is no more convertible. So it is value of option free bond. Value of, not risk free, okay? Option free bond. The bond, if it was not convertible, that is the minimum value. Same like how you derive using the spot rates. But the minimum value is higher of both or lower of both? Can someone help me? It is higher of both or lower of both? It is, yes, anybody? Higher of both or lower of both? Well, it is higher of the two. It is the higher of the two. So if the straight value is the bare minimum, it is a floor. It is higher of the two. If the market conversion value goes up, you will get more value. That's why it's called a hybrid security and dual advantage. All right, everyone, check. Now, very important are this parity related formulas. That is a trouble for many students. Parity is like a break-even point. Okay, so market conversion parity. We will write the full name also, market conversion parity, or parity means price here. We are trying to find the break-even point. So here we are expecting that we recover the investment in the bond through the conversion. So what is that break-even price? So we take the market price of the bond. Which bond? Convertible bond. So I will write market price of, not just bond, convertible bond, right? Convertible bonds are generally sold at premium. Remember that. Market price of convertible bond divided by the conversion ratio. That will give me the break-even point, the parity at which I will just recover value enough of my investment. Enough of my investment. Correct? That is my market conversion price. This is calculated in terms of, this is going to give me a price. But if I want to find the premium, conversion premium, please note this. You will find conversion premium in dollar and conversion premium in percentage. In dollar and in percentage. In dollar and in percentage. Now, this is very important. If I want to find in dollar, I will just take the difference between the market conversion price or parity. We call it as MPP. I will call it as MPP. Sorry, market conversion parity, MCP, I will call it. So this is the break-even price, right? So we will take how much extra are we expecting. As of now, the stock price might be low. So we will take the market conversion price or parity price that we got minus the current market price of company stock. That is the conversion premium in dollar per share. Conversion premium. This is conversion premium in dollar, but per share. I will write down it is per share. How much is it in dollar per share? But if I want to find that in terms of percentage or ratio, what we do is that we take this per share value divided by the stock price. So in that case, I will take the conversion price, correct? Conversion price per share. This is the conversion premium per share and divided by the base price. What is the base price? The base price is the current market price of stock, current market price of the stock of the company. This will give me in terms of ratio. Okay, so let's say the conversion price is 50 and the current market price is 30. So 50 divided by 30, I can put it up in ratio. If they ask me to find in terms of premium percentage, all I will do is minus 1 into 100. So if you want to put in ratio, this is it. If you want to get it into percentage, you will multiply this with 100. Have you understood this, everyone? Clear, 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 clear. There is one more formula which is premium over straight value. Remember, convertible bonds are always sold at premium. So when we buy convertible bonds, we are paying premium. So we are going to find out how much is the premium you paid to the bond. So premium over the straight value. Straight value is the value if it were not a convertible. This is also in percentage. So what is the market price of convertible bond divided by simple the straight value of the convertible bond? So the straight value of convertible bond minus 1 into 100. That will tell you how much you paid extra to buy this bond in percentage. All right. Too many formulas, I understand. Finally, we are going to find the arbitrage-free valuation of bond with option. We will find arbitrage-free valuation of embed option bonds. I will write option bonds. Now, in this case, we will consider all the option together, callable, puttable, convertible, everything. So, first of all, we will take non-callable or simply convertible bond. Rather than saying, I will say convertible bond, right? And then the second valuation we'll be doing for a callable convertible bond. The third will be callable and puttable together, and puttable convertible bond. That is the maximum. 1, 2, 3. Okay, we are trying to find the value of the bond. So yes, a convertible bond has an extra feature over and above the straight value. So over and above the straight value, what is that extra feature? That is a call option on the stock. So we take call option on stock of the company. Convertible bond is like a call option on the stock. So whenever you see convertible bond, you will always say straight value plus call on stock. That will always be there. Straight value plus call on stock will always be there whenever you see the word convertible bonds. If it's callable, remember callable feature is with the feature of call is with the issuer. So do we have a call? Are we long call or short call? Anyone would like to answer? Call on bond. Are we long call or short call? In a callable bond, we are short call. So I will write here minus call on the bond. Minus call on the bond because we are short call. But if it's a puttable bond, we add the call on the bond, isn't it? We add the put on the bond. Sorry, I will say put on the bond. We add it. Why? Because we are long. Are you getting the difference? Remember, value of convertible bond, yes, will be higher. Callable convertible will be slightly lower, but if you add the put feature, it will increase. All good, everyone? Clear? Okay, this is where we complete all the formulas, massive formulas till reading number 3. Reading number 3 is where the maximum chunk is. Reading number 4 and 5, 4 related to credit valuation models, and 5th related to CDS are unique. Everyone understood till this point? Clear? This credit analysis model is one of my favorite topics because it has a massive calculation in terms of something that we did in level 1 also, expected exposure, recovery rate. All of these formulas are very important. Many of the formulas are common sense. For example, expected loss is very critical. So I will write down the basic, even though it's basic, but we will write expected loss on a bond if the bond defaults. That expected loss has two components: probability of default and default on what? Default, probability on default if the bond has defaulted. So if the bond has defaulted, how much is the loss, which is called loss given default. Loss given default. Loss given default is nothing but how much you will lose if the bond defaults, which is the opposite of recovery rate. Remember, what is loss severity? Loss severity means how much you will lose if the bond default, which is simply the opposite of recovery. Recovery. So if they give you loss severity is 40%, recovery rate is 60%, and vice versa. So if they have provided you recovery rate, again, loss severity is in percentage, recovery rate is also in percentage, opposite to each other. In this topic, the important thing were two: hazard rate and probability of survival. Probability of survival is cumulative. Probability of survival is cumulative. Based on that, it is actually better seen using the table. How do we derive it? Because hazard rate and probability of survival, even if I write down the formulas, it will be not making sense. So I'll write down the formula. It is cumulative probability of default. Just for your reference, it is cumulative probability of default. And survival means every year when we test, we are considering the bond did not default. So it is nothing but 1 minus cumulative probability of default. Cumulative means over the period you did not default. So we say 1 minus cumulative probability of default. So when I'm finding probability of survival in year 5, I'm assuming the bond did not default in the first 4 years. All right. I will just show you how we did that in the example here. So they will provide us with the hazard rate of 2%. So first year probability of default is 2. 2. Second year, what is the probability of default? So, guys, you defaulting in second year means first year you survived, isn't it? First year you survived. So, if you do probability of default in second year, assuming you survived in the first year. So, if you multiply both, you will get probability of survival default in year 2. Are you with me? So probability of default in year 2 means I survived in year 1. Are you with me? I survived in year 1. This is where I will write down the very important formula. If I want to find probability of default, let's say in year 2, okay? That means I survived year 1, means I survived the previous year, right? So if I want to find, let's say, probability of default in, I will write t plus 1. All right. That will be equal to probability of survival in year 1. Yes or no? Into the hazard rate that they give me. Hazard rate into the hazard rate for hazard rate for that particular year. So I will take hazard rate for t plus 1. So this is, I will say this is t plus 1. This is, I will say t. Are you with me? Understood this? Everyone clear? So put their probability of default. Sorry, I will write this way. Probability of default in year 3. If I say probability of default in year 3 means I survived the 2 years. Probability of survival in year 1 and 2 into the hazard rate. Is this clear, everyone? Very interesting. Even though I'm writing the formula, you can't analyze it unless you put up in the table. For example, I want to find probability of default in year 3. That means I survived the first 2 years. So what is the survival probability? Everyone, 0.98 into 0.98 into the probability of default. If you do this, you will get the answer. Can you tell me how did I get this? I survived the first 2 years. So that is 0.98 into 0.98. Correct? And into 2%. If you do this, you will get the answer. So 0.98 square into 2%. You will get the answer 1.92. Are you getting this? Check, confirm. So even though I'm writing the formula, it will not make sense. It is better done with table. All of this is used to find what? CVA, credit valuation adjustment. This is something that I expect to be tested in exam, even though we do it tabular wise. But what is CVA? CVA, if you notice here, CVA is nothing but the summation of present value of expected loss in each period. So present value of expected loss in each period. So we want to find CVA, credit valuation adjustment. It is nothing but the present value of all the expected loss in each period. So present value of expected loss in each period and the sum of it. So I will write sum of. So I will write sum of what? Sum of what? The present value of expected loss in each period. That is the difference between a risk-free and risky bond, isn't it? So what is the value of the bond when there is no risk? When there is no risk, we say VND, credit risk, right? VND means value of bond with no risk. Everyone. In this case, we find the value of the bond by discounting it with the benchmark rate. So we will do what? We will find the value of the bond, discounted at benchmark rate or the spot rates. All right. This is assuming it's risk-free. But from this bond value, I know there is a risk. So if I want to find the value of risky bond, should it be higher than this or lower than this? If I want to find the value of risky bond, will it be higher than this price or lower than this price? Based on that, you will remember the formula. Will it be higher or lower? It will be value no
Lower.
default minus CVA, right? Why minus? Because the value should be lower. Risky bonds yield is high. Price is lower. Understood, everyone? This clear? Very, very highly testable VND. VND highly testable in exam. All right. Yes. The entire topic was about CVA, right? Then there are some formulas which are repetitive. You will see all of this VND calculation throughout the syllabus. You will see VND. There is risk neutral probability calculation. Do not worry, this is repeated in derivatives. So we'll discuss how to derive the risk neutral probability. Just that here, the probability of default is derived using the weighted average of the price, if the bond defaults and if the bond doesn't default. So P here is the probability if the bond defaults. So if you want, I can write down what is the implied probability. We will write down implied probability. We are trying to find what is the, this is the concept called implied probability. And to derive this, we are assuming that, let's say after a year, the bond will have two valuation. It will go up, means it will default or not default. So P is probability of default, and 1 minus P is that it will not default. If it defaults and if it doesn't default, the weighted average of both should be the bond's present value. So if it defaults, how much will I get? And if it doesn't default, how much will I get? Right? So we take the weighted average of the amount that we will lose. So amount, how much we will lose and how much we will recover. So if there is a default, we will consider how much we recover. And if there is no default, in that case, that is P1 minus P is no default. If it doesn't default, how much will I get? So 1 minus P into the value if the bond doesn't default. So when the bond doesn't default, how much will I get? I'll get the full value, right? So in that case, we will take the par value or the full value if it doesn't default. This will happen on maturity. So if we discount them with the risk-free rate, because in derivatives we use the risk-free rate, that should be equal to the present value of the bond. This concept is not used to find the present value, but this concept is used to find the P, probability of default. Rarely used, but you should know that this is how we derive the implied probability. All right, implied probability. One formula that came in between I had to discuss. Otherwise, don't worry too much about this. All right. Now, in this topic, there was a unique discussion on the structural valuation of the company, the structural models. You will see the structural models here. No need to memorize the structural model formulas. They basically tell you the value of the company's equity and debt. Remember, value of firm is value of debt and equity. So you can perhaps skip this section. No need to memorize the formula. But you will see VND related something tested in exam. There's a high chance of VND related testing done in the exam. Okay. There's a lot of concepts here in this topic which are very important. You will see the credit changes in credit spread. How does it impact the bond? And one of the unique thing about this bond was the collateral pool discussion in CDOs. So that is all not a part of formula, but a lot of concepts, right? Apart from formula. In fixed income, the formula might look lesser, but it is way beyond the formula, correct? All right. Now comes the last reading, that is CDS, credit default swap. In credit default swap, one of the most common formula is under the two different types of CDS, single name and index CDS. In single name CDS is what we derive the payoff. So payoff in a single name CDS. Let me walk you through single name CDS, everyone, where there is a concept of cheapest to deliver, right? What is the market value of CTD? We will discuss this, right? And there is a single name CDS formula, that is a payoff. Notional principal minus market value of CTD, cheapest to deliver. So we will write down first what is the CDS payoff. CDS payoff. It's a combination, it's a difference between two things. That is the notional principal of the bond minus the value if the bond defaults, right? So when the bond will default, what is the cheapest to deliver market value? So the market value of cheapest to deliver, and this cheapest to deliver is based on what? The cheapest to deliver, market value of cheapest to deliver. Very, very important. So you will be provided with several bonds. The bond with lowest discount to par, lowest discount to bar, that will be chosen with the same ranking. So with the same seniority, you will choose the bond with the lowest discount to par. So just to give you an example, 50% and 45%, both are same seniority. Of that, the lowest 45% to par is your cheapest to deliver. That you will subtract from the notional principal. that will be your CDS payoff. One formula that you should remember apart from the remaining formulas that I will discuss. This is the CDF formula. Don't get into the mess here. Simple formula, CDS payoff. All right. The one complicated thing in this topic was the CDS spread. What is CDS spread? Credit default spread. See, remember, one party will pay coupon, one party will pay coupon, and in return, they will receive the amount if the bond defaults. So CDS spread is dependent on the default, right? The higher the probability of default, the higher will be the spread. So it is probability of default, or simply PD, into how much will we recover, one minus recovery rate, how much we will lose. So probability of default into 1 minus recovery, that is your CDS spread. There are two things, CDS spread and CDS coupon. CDS coupon is what we will pay, and CDS spread is what is determined by the market. CDS spread and CDS coupon. CDS coupon is what we are going to pay. The difference between, guys, CDS spread and CDS coupon, the difference between both has a name which is very unique. What is that called? The difference between both has a name. Is called upfront payment. That is called upfront payment. Upfront payment is the difference between CDS spread and CDS coupon. Both are in percentage. You will multiply that with the duration of the bond. This is very unique. Everyone, you can check out there in our notes. Where is this? CDS spread. Yes, upfront payment. Please check out this. Upfront payment is CDS spread minus CDS coupon. If you just do that, it's in percentage multiplied with duration will tell you the upfront payment. This upfront payment, when calculated in percentage, that is what will subtract from the par value of the bond. That will tell us the upfront, that will tell us the price of the CDS. Now, I don't expect price of CDS to be tested, but still I will write down here. Price of CDS is nothing but $100 minus whatever was the upfront premium. Upfront premium. Upfront premium, let's say it is 10 percentage. So 10 percentage of the $100 will be subtracted. The price of CDS will be 90. Is this clear? Right? Three formulas related to CDS, CDS spread, upfront payment in percentage, and through that we find the price of the CDS. Price of the CDS. In the CDS, how much will be the gain and loss? So we are going to calculate the gain and loss similar to what we just did. But here, changes in the CDS value. Yes, we will now look at valuation of the CDS. Look at this. This is nothing but the valuation of CDS. This is the benefit for the protection buyer. So I want to find the payoff or the valuation for protection buyer. Valuation, remember, is gain or loss. Valuation means gain or loss for protection buyer in CDS. In CDS, what is the valuation? Very important formula. So we can derive the profit or gain and loss in dollar or gain and loss in percentage, either in dollar or in percentage. Now, simply in order to calculate in percentage, we just do changes in spread, CDS spread into duration. Now, the same thing, if I multiply with notional principal, I get in dollar. So changes in spread into the duration of the CDS into notional principal. If they give me notional principal, I will get the answer in dollar. Otherwise, I will keep it in percentage. This is the CDS payoff for the protection buyer. Clear, everyone? Right? This is the end of all the possible formulas of your fixed income. Massive formulas, too many formulas in fixed income, but beyond the formulas, there are a lot of concept in fixed income. Around 50 plus formulas you must have seen. That is all the formulas of fixed income. Got it, everyone? Any doubt, any questions in this? Too many formulas. Formula doesn't justify everything about. See, in level 1 and level 2, where is the difference? In level 1, of course, did you notice level 1 is more about calculation or theory? Level 1 is more about calculation or theory. Level 1 is more about theory, right? Level 2, it is opposite. But still, theory holds a sizable weight. So in level 2, I would say the proportion of practicality is much more than level 1. That's why we, at the end of the day, we also have to remember all the formulas. But still, it has substantial theory. So formula may not justify everything that is in the concept, but still having it at one place. So what happens when you revise? You're not worried what is the formula. You know, okay, this is the formula. So your focus is on the concept. And when you apply the formula, it freezes in your head. Maybe you will not remember all the formulas in second reading, but third reading, you will start remembering all the formulas. Level 2, unfortunately, has a lot of formulas. Okay. But only when you do second or third revision, that's where the formulas become much more reasonable, much more understandable, and that's where you will remember them. All good? Yes. Any doubts, any questions? Okay. Derivatives has just two readings, 5 to 10 percentage weight. The first reading is about forward future swap, and the second reading focuses on the different types of options. Yes. The second reading is where we will discuss about the first reading, pricing and valuation of forwards, majorly including FRA and swaps. Third, first reading, and the second reading is about options. Okay. Let's start with valuation of forwards. Yes. You will see in forwards formulas related to. Let me also go to this derivatives in our notes, everyone. In the reading, yes, if you will check here, FRA, swaps, everything will come. Price and valuation should be our primary focus. Price and valuation. First thing first, we will calculate no arbitrage forward price. No arbitrage, simple no arbitrage forward price based on time value of money. So forward is simply spot into 1 plus risk free to the power t. Remember, throughout the derivatives, we discount at the risk free. This is a simple formula for no arbitrage forward. Then you do cash and carry arbitrage, and then this is the basic formula. But now if I want to find the formula, this is common for all equities, commodities, everything, right? But if I want to find the no arbitrage forward price for equity, for equity with and without dividends, we'll focus for equity with and without dividends, and then we will derive no arbitrage forward price, no arbitrage forward price for equity index, for equity index. All right. This is where things will be different. Now, this is where we will discuss without dividend and with dividend. So the basic formula that we all did was without the assumption of any dividend between the contract period. So if there is no dividend, then the formula that we just did forward, that we just did for equity, right, is spot into 1 plus risk free to the power t. This is the formula if there is no dividend. If there is dividend, yes, then in that case, with dividend, so I'm expecting dividend in between the contract maturities. So what is dividend? Dividend is an income. Do the guys in derivatives get dividend? No. So what we do, we calculate the forward, we subtract the present value of dividends from the spot, everyone, and then we do into 1 plus risk free to the power t. Everyone with me? This is how we will do for equities. Yes or no? Clear? All right. Yes, this is how we will do for equity. I hope it's recorded. Yes. Then for dividend, you can also adjust at the end. So there is one more component of adjusting for dividend. It is the same formula. Another variant. Another variant is assuming dividend is received at the end. So what we do? We do 1 plus risk-free to the power t minus future value of dividends. Future value of dividends, right? At the end. Index, in case of index, we don't take dividend, we take the dividend yield and we take continuously compounded rate. So in this case, with and without dividend, I will do without dividend, and then with dividend, I will not say dividend, I will say dividend yield. With the dividend yield. In that case, my no arbitrage forward price, or future price, whatever you call it. In this case, this is for index. So it is S0 into E exponential to the power risk-free into the time. Remember, risk-free into the time factor, because a period may be 3 months, so you'll do 3 over 12, etc. Now, the same formula, if there is a dividend yield, we take risk-free minus the dividend yield. Minus the dividend yield, this entire factor into time. So minus, so we take the net effect on the numerator. Everyone with me on this? Clear? Everyone? Similar case for, this is for equity and equity index. In case of bonds, if we want to find the pricing of bonds. Now remember, as of now, I'm just focusing on pricing. We will focus on the valuation later. But if I want to find the pricing of bonds, equity forward I did. Now bond forward, in that case, just one thing will change. In order to find the forward of bond, I will take S0 minus present value of coupon, assuming it's a coupon bearing bond, into 1 plus RF to the power t, isn't it? So what has changed here? Only one thing has changed. Instead of present value of dividend, what we've taken? Present value of coupon. All right. Again, you can adjust the coupon at the end also, or you can take it at the front. Same like what we did for equity here. This is the only difference between bond and equity forward. But now when we say valuation is always gain and loss from the point of view of long. And this valuation is always the difference between the spot minus the present value of forward. Remember, it is the spot price minus the present value of forward. This is what the valuation is. Valuation is gain and loss. Valuation is gain and loss. So when we derive the valuation at inception means time is 0, at maturity, at t, and at t, small t is before maturity. In this case, what is my valuation? Everyone in the class, my valuation even before I calculate. In this case, the valuation at inception is always 0. Later on, there can be gain loss, but at inception, it is always 0, because we are trying to get the difference between spot and present value of forward, and present value of forward and spot at the beginning are considered as same. Yes or no? Everyone? Later on, they will change. For example, on maturity, we take the maturity price and the forward that we booked. That can result in gain loss. Before maturity, it will be forward again discounted for what? Discounted for the remaining period. So we say big T minus small t. For example, let's say the maturity is 12 months and we are settling at the end of 9 months. So that will be 12 minus 9, that is 3 months. Is everyone cleared with the valuation? It's exactly same as what we did for L1. Just remember that if there is dividend for equity, wherever there is spot, you will adjust what? If there is a dividend, wherever there is spot, from that you will subtract the present value of dividends. Are you with me? Or if it's a bond, it will be present value of coupon. That's the only difference. Is this clear? So pricing and valuation of bond and equity forward and index is all clear. Perfect, everyone. Now, the one concept which is a troublemaker for student, even though it's a single page discussion, that is about bond futures. In bond futures, the institute will probably ask you something about quoted future price. What is quoted future price? First, let me tell you, quoted future price is nothing but the future price of the bond adjusted for something that we call as the conversion factor. Remember this, CF is conversion factor. Conversion factor will be provided to you. So whatever is the bond's price, the future FP is your future price divided by the conversion factor. Now, the problem is that to get this, you have to go through the concept of clean and dirty price. Clean and dirty price. So everyone knows full price and flat price. What is the difference between both? The difference between both is due to accrued income or accrued interest. Clear, everyone? Full price and flat price. It is the full price, which is nothing but the flat price plus accrued interest, isn't it? Plus accrued interest. And accrued interest is nothing but the interest since the last coupon. So let's say the bond had a coupon of semi-annual coupon of $50. So since the last coupon till now, how much has been accrued? So it is days since the last coupon, divided by the total days between two coupons. Let's say if it is semi-annual, the total days is 180. So last coupon was paid 30 days back. So 30 divided by 180 into the coupon amount. The coupon amount can be annual, semi-annual into the coupon amount. This I will write down. It is what? DLC over DC. I'm writing the short form. In the note it is full form. Days since the last coupon. Days since the last coupon divided by days in the coupon into the coupon amount. That is your accrued interest. It is basically interest accrued till date. Understood? What is the other name for full price? Full price is also called dirty price, and flat price is also called the clean price. I will write down the name. Full price is called dirty price. Flat price is called clean price. Understood, everyone? Full and flat, correct? Full and flat, yes. Here, there are too many formulas. My suggestion to the class will be that you should know the difference between both. What is the full price and flat price? It is due to accrued interest. So in case if I have to find the flat price, I will take the full price, right? From that, I will subtract the accrued interest. From that, I will subtract the accrued interest. That will be my flat price. Flat price is also nothing but the market price of the bond, futures, you can say, divided by the conversion factor, that is your quoted future price. In the class, I have discussed this in much detail. I'm just using here the shorter form. So please understand, if you want more detail, you can read the concept, but at the last moment, you should know what is quoted future price formula and what is a full and flat price. Is this clear, everyone? Conversion factor will be generally provided to us. Okay. Now, any difference between the no arbitrage, this is what is going to help us understand the quoted future price is nothing but no arbitrage quoted future price. So we said no arbitrage forward price, right? Here I will say no arbitrage quoted future price. So this is what my intrinsic value is. I'll compare with actual future price. The difference is going to be my gain loss. So in case if I have to derive the arbitrage gain loss. Arbitrage will always result in gain, right? So if I were to find arbitrage gain, it is always the difference between these two prices. That is the no arbitrage, not forward price. I will say no arbitrage future price minus the actual future price. The difference between both will be my gain. This is the only thing you need to remember. I will remind you again that in reality, we did a lot more formulas in depth into this component. I discussed all this component at length. You can go through the concepts of revision in case if you want, but suggestion to you is remember this as the basic ones. This is the bare minimum that you should remember. So pricing and valuation, I generally tell students pricing and valuation for forward is okay. This is all for forward. For futures, you only do if you have time because there's too much of information about the futures mentioned in your notes unnecessarily. All right, this is about bond futures. The two more things in this topic was about FRA, forward rate agreement, something that we already learned in the fixed income using spot forward. FRA notation is very important. Remember when I said 2 by 3 FRA, 2 by 3 FRA, everyone? What is it? 2 by 3, 0, 2, and 3. It is a 1 year rate, 1 year rate or 1 year forward after 2 years, isn't it? I repeat, am I correct? It is 1 year forward after 2 years. That is what my 2 by 3 FRA is. Everyone with me on this? In reality, the FRAs are generally in days. So if this were to be converted into days, how will I say? 60 by 90 FRA. So it will be a 60-day, it will be a 30-day forward after 60 days. Am I correct or incorrect? Everyone, understood? Check, 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 check. Now, in FRA, pricing is similar to what you already did, spot forward. So if I have to find the 30-day forward, what will be my equation? I will take the rate for the first. I will take the rate for the 60 days. Everyone, I will take the MRR of 60 days, 60 over 360. Here we take 360. Anyone? And then what will I do? Here we don't do to the power because it is in days. Anyone would like to contribute? What do we do? Multiply with 1 plus MRR of which? It will be MRR of 30 days after 60 days. So which we don't have. So we say here, this is where the forward is. So this is where the FRA rate is. FRA rate for 30 days out of 360 days should be equal to the 90 days. So I will take 1 plus MRR of 90 days. Are you understanding this? Everyone, into 90 over 360. 90 over 360. This equation will help me solve the balance here, the FRA rate. Everyone with me, hopefully. All right. We did the same concept in fixed income, but there we did compounding. Here, the balance is what we will get. This is how we price the FRA using the spot rates. Spot rates. Spot rates. The most important here is valuation of FRA. Valuation of FRA, very, very critical for your exam. How to value an FRA. We always value from the point of view of long. So valuation of FRA from the point of view of long is you booked a rate, forward rate, you'll compare with the market reference rate or the spot rate. So it is MRR minus the FRA rate. So MRR rate minus the FRA rate. The difference between that is always multiplied here with the days and notional principal. Do not forget these two adjustments. You have to adjust for notional principal, multiply to get into dollars, into D by 360. Always do 360 if not mentioned. All right, the default year is in FRA 360, the day count convention, but the settlement is earlier. So what we do? We discount it with the MRR percentage into D over 360. Now, guys, very important, very important, very important. What is this days? Is this day and the underlying days, are they all same? This is underlying asset days. Not always. Only if you are settling the FRA on the contract maturity. If you are settling earlier, this is the days. This is the days, basically how earlier you are settling. So it is actually the difference between the maturity and the settlement date. So this day and the numerator days is for the underlying. They both are not same. Now, let me tell you how. Okay, so that you can relate it. For example, in our 60/90, so this is everyone, this is 60/90. If I do 30/90, it will be 0/30/90. So this is my 60/90 or 2 by 3 FRA. In this case, the formula that I drew here, everyone, I will pull it here again. Let me pull here the valuation so that you can understand this. Here, guys, what is the underlying duration? Underlying duration is 30 days. I'm ideally supposed to settle the FRA on maturity, that is 60th day. Am I correct? So if I'm settling it on maturity, then both of these days will be same or not? Same. But if I'm settling it earlier, let's say I'm settling it at the end of 50th day. This is 50th day. Then the numerator will have 30 days, but the denominator will have how many days? How many days? From maturity till 50th. That will be 40 days. Excellent. Understood, everyone? So it depends, when are you settling? Are you settling on maturity or earlier? So this D represents the difference between time to maturity and the settlement. That is maturity date. This is T. And when am I settling the contract? Is this clear to the class? Everyone in the class? Check, check, check. This is very, very highly testable as per me. Okay. The same valuation, guys, the same valuation. This is for forwards, okay? Or this is for FRA. FRA is forwards. But if the same valuation they ask you for futures, in futures, again, for long, you don't have all this drama. In futures, you don't have all this drama. You will simply take the current future price minus the originally taken position price, the previous price. This is basically, instead of T, I will say T minus 1. T minus 1. So let's say I'm settling the contract between the two dates. So the difference between the future price, all of this is mark to market. So it's a daily difference. Okay, it's a daily difference into the notional principal. That would be my valuation if it's a futures contract. Futures are settled daily. Everyone, Understood the valuation of FRA? In FRA, be ready for pricing, which we just did, similar to the spot forward in fixed income. Valuation, especially valuation of forward, highly testable. Is this clear? All right. Now comes swap. My favorite for exam is swap, especially interest rate swap. Here we are going to derive two things. One is the fixed rate of swap and again the valuation of swap. So swap fixed rate. So swap fixed rate, that is the price of the swap. Swap fixed rate is nothing but pricing of swap and valuation. Pricing and valuation. Pricing is nothing but swap fixed rate, and valuation is from the point of view of whom? Value for fixed rate, like long you have there, like long in FRA. Here we say value is always for the fixed rate pair. Valuation is always from the point of view of fixed rate pair in the swap. Is that clear, everyone? Now, very unique in case of swap. What is the unique thing in case of swap is the discounting factor. Very, very important. I'm going to compress the formula in such a manner that if they want to find the swap fixed rate, you will always take a rate which is the final discounting factor. So I will take 1 minus final discounting factor. I will write final discounting factor. Let's say discounting factor in year T divided by what? Summation of all discounting factors. Summation of all discounting factors. This is your swap fixed rate if it is annual. If it is not annual, let's say if it is semi-annual, then what will I do? If it is semi-annual, I will multiply that with 2, right? How many periods in a year? So let's say if it is semi-annual, I will multiply with 2. If it is quarterly, I'll multiply with 4. So the multiplication will be based on periods per year. So if it is all discounting is quarterly, how many quarters per year? 4. Multiply with 4. If it is semi-annual, how many semi-annuals in a year? 2. So multiply with 2. Is everyone clear? That is how I will derive my annual swap fixed rate. And the important thing, because the discounting factor are in days, how do I find the discounting factor? Discounting factor, how do we derive the discounting factor, guys? We take 1 over, they will provide us with market reference rate. Remember, this market reference rate is for days. So you will adjust, interest rate is always annualized. So you will adjust always for D over 360. This is how you will get the periodic rate or periodic discounting factor. Then you will find the pricing. Then you will annualize it. That's your swap fixed rate. And the valuation is the difference between this rate and the actual MRR. So the valuation is difference between SFR new rate minus SFR new rate is the new reference rate minus the rate that you booked, minus the swap fixed rate that you booked, the old rate. Both of them multiplied with notional principal, because all of this is calculated on a principal, for the days D over 360. However, remember one thing, is swap a single cash flow or a series of cash flow? Swap is a series of forward, isn't it? So do not forget, all of this needs to multiply with the summation of discounting factor. That's the most unique thing, because it's not one payoff, it's all payoff. So all of this into summation of discounting factor. This is just one payoff. One payoff. All of this into summation of discounting factor will be total valuation for the fixed rate pair. If the rate goes up, it will be positive. If the rate goes down, this will be negative. Do expect swap related formula in exam. Very, very highly testable. Swap related formulas, especially the pricing and valuation, highly testable. Understood everyone till this point? Now we'll move to all the option related formulas. Yes. Valuation of contingent contract. This is where you have everything about options. Various options are measured using two ways, not various, two valuation models. One is binomial, same as what you learned in fixed income, similar to that, and then Black and Scholes, right? In the binomial option pricing model, there is a probability of upside which you derive using risk neutral model. So risk neutral model based probability of up when the stock goes up. So that probability formula you have to remember. So it is 1 plus risk-free rate minus the down factor divided by the up factor minus the down factor. This will give you probability of upside. 1 minus this will be probability of downside. And then you find expected payoff. Expected payoff under the options. So you have two payoff. One is then the value of call when the price goes up into probability of upside plus value when the price goes down into the probability of downside. This, when discounted with the risk-free rate, let's say risk-free rate for the time, let's say the option is for 1 year, that present value of option is going to be the value of call. Understood, everyone? This two? Clear? This is how we derive the value of call option, similar for the put option using the binomial or risk neutral model probability. The second formula which is critical in this topic is the put call parity. Put call parity compares two equations. What are the two equations? Protective put should be equal to fiduciary call. Protective put positions. Yes, anyone can remind me what are the protective put position? It is long a stock and long a put is equal to fiduciary call. Fiduciary call is call plus present value of X. Why present value of X? You are investing in a bond which will pay you X on maturity. This is a zero coupon risk-free bond. This equation should always match. The payoff on the left and right will always be same. Correct? Now, what is the other formula? Everyone understood this? Right. The other formula is about delta, the hedge ratio. Highly testable. Hedge ratio. Hedge ratio is nothing but delta, which is nothing but ND1. We call it as delta or even ND1. It is change in the value of option due to the change in underlying. So we say change in the value. Let's say if I'm doing it for call, so change in the value of call over the change in underlying asset or spot. So the difference between C plus and C minus and S plus and S minus, that is when the prices go up and down, that difference will give me the hedge ratio. Remember, hedge ratio tells you the number of shares you require to hedge the option position. This hedge ratio is nothing but it is called ND1, which is going to be a component in the Black and Scholes model. Black and Scholes model. So now, everyone, how do we utilize this? So this hedge ratio multiplied with something, will give me the position. So how do we convert this into deriving the number of shares that I need to buy or sell? First of all, how many number of shares I need to buy or sell, that depends on what is my option position. If my option position is bullish, that is, what is the bullish option position? Long call and short put. So then I need to sell the shares. Then I need to sell the shares. Everyone with me? Check out here. Where is it? We are under derivatives. Under the derivatives. Okay, see here. If I have a long call or short put, that is a bullish position in option, underlying I will do short. Underlying I will do short. Underlying I will do short. So long call or short put in the underlying I will do short. Short call or long put in the underlying will do long. So the delta we have into the option position, that will give us the underlying position. So if I want to find how much is the underlying position, my underlying position equals to delta, everyone. Delta, that is nothing but the hedge ratio here into the option position. Into the option position. So basically, if I have 100 options, into delta is the number of shares I need to buy or sell. So if I have 100 option into, I will repeat, into the number, into delta, or the hedge ratio is the number of shares I need to buy or sell. Is everyone clear with this? Check, check, check. Understood? There is a minor discussion on interest rate call and put option. Interest rate call and put option payoff. So when we calculate payoff for interest rate option, we will calculate interest rate call option, interest rate call option payoff, and interest rate put option payoff. Remember, payoff is always from the point of view of long, long, long. So long will get paid off when the rate goes up. Very, very interesting. So when the rate goes up, it is market reference rate minus the strike rate. Strike rate, that is X. Market rate reference rate minus the strike rate. Remember, this is the difference. But since it is option, we always write as maximization of this or zero. Maximization of this or zero. Everyone recollects this? This multiplied with notional principal into the days. So notional principal into the days. Days under the futures or options contract is based on 365. However, my suggestion to student is that always check out the information in the question. Generally, it is for 365 or 360. Don't get into that controversy. They will provide you. Okay. Futures and options are generally for 365. Forwards is generally 360, especially interest rate derivatives. So 360 or 365, don't get into that confusion. For put, it will be maximization of strike rate minus MRR or zero. Are you with me on this? Rest of the things will be same. Into notional principal into days over 365. Similar to FRA, isn't it? The only thing is that now there are two sides, either gain or zero, but no loss because we are always assuming from the longs point of view. All good, everyone? Now I will discuss the formula of Black and Scholes model. This is where students are sometimes confused. Should I remember the model or not? We will do Black and Scholes model for equities where our assumption is no dividend. We will assume no dividend. And then I will tell you what if there is a dividend, what is a minor difference. Okay. So only remember the basic Black and Scholes model. Rest all you need to understand are nothing but the variants of it. So Black and Scholes model, call and put value using Black and Scholes. I will tell you the technique. What is the call payoff? Call payoff. ST minus X. ST minus X. In present value terms, how will I write? As 0 minus present value, everything we do exponential, minus present value of x. X is on maturity, right? Is this clear? For put, what is the put payoff? Present value of x minus st, present value of st is s0. It is just the opposite, isn't it? Are you with me on this until now? Correct. Now, what are we going to do? We are going to multiply the S0 with ND1, the hedge ratio. Why? I will tell you. But here, if it is a call, it is ND1. If it's a put, it is ND minus 1. So we will write ND minus 1. Are you with me on this? Everyone? For the strike price, present value of strike price, we multiply that with ND2 if it's a call. And can someone tell me if it's a put, what will I do? N minus D2. Is everyone clear with this formula? It is similar to ST minus X, X minus ST. ST is spot at maturity, X is strike price. All good? Now, I will just break down these components into the meaning of it, which is very, very crucial. Guys, this position spot into ND1, what does it suggest? It is a combination of two things. This is a long stock. How many shares I will buy, right? ND1 is the hedge ratio. Long stock, and when I long a stock, will I borrow the money? To long a stock, I will borrow the money or I will lend. I will lend. So this is long stock and this is the borrowing amount. Borrowing amount is nothing but a short a bond. When you short a bond, it's borrowed. So this is nothing but it's called a borrowed long position or a leverage long position. So Black and Scholes, the call is nothing but it is called what? This together are called, this together when you do this, it is called, yes, what is that called? Leveraged long position. So you took a long position in the stock with leverage. So we call leverage long position. Are you with me, everyone, on this? Put, can you try for put? Put is like you're selling and investing. When you sell, you invest, right? So under the put, like here under the call, we had long stock and short bond. In put, I will not say short bond. I will have a position which is equal to long a bond. And this position is equal to short a stock. So this is called leveraged short position. Leveraged short position. Now, if you carefully see, call is nothing but it's like borrowing and buying a stock. That's why you pay the premium. Is everyone clear with this Black and Scholes concept? All good? This is the basic formula and its derivations. Now here, for your reference, I don't have enough space in the page, but D1, D2 or ND1 and ND2, what is ND1? What is ND1 minus? What is ND2? And what is ND2 minus? That you should know. No one's going to ask you the formula for this, but you should know what are they used for. Yes, ND1 is nothing but the hedge ratio. As we said, how many shares? So that is nothing but the long shares, the number of long shares that you need to. So can I say ND1 minus is nothing but short shares? How many shares we are going to short? Correct? Everyone? ND2 is unique. ND2 is probability that the option will expire in the money. Probability that the call will be in the money, because if it is in the money, then only you will exercise, isn't it? So ND2 minus is the probability that probability that put will be in the money. Now, for a similar strike price, only either of the two can happen, right? So if ND2 is 40%, remember ND2 minus is 60% because these are probabilities and they are called risk neutral probabilities, just what we derived. Risk neutral probabilities, risk neutral, the way we derived. Everyone. So guys, I can find ND1 and ND2 negative also. I can find what is ND1 negative. It is simply 1 minus ND1. And this is simply 1 minus ND2. Everyone with me on this? Understood the components? Everyone? Yes. Now, this is what the Black and Scholes model is. We discussed this model. Just remember this basic model. In case if they ask you black model or if they ask you any component of this was without dividend. Now, just remember if they say dividend, where do we adjust the dividend? In the spot. So wherever there is spot, you will adjust for dividend. So in the same formula, if there was a dividend, wherever there is spot, I will adjust it for dividend. Remember, dividend is subtracted. So I will do minus dividend yield. If there is a dividend, I will just do this adjustment. I will write down here somewhere. This is the adjustment I will do if there is dividend. If there is dividend, wherever there is spot, you will do into e raised to minus dividend yield. Wherever in the formula, you will see wherever there is S, in the call also there is S, in the put also you will notice there is S. D1 and D2 you do not have to calculate. Okay, D1 and D2 you do not have to calculate. This is my call and put option on equity with and without dividend. If it was forward, now see, understand what is black model. In black model, wherever there is a spot, what is the difference between spot and forward? Everyone, how do we find the forward? Forward is nothing. The no arbitrage formula, forward is nothing but spot into 1 plus RF to the power T. Now, if I take this 1 plus RF to the power T on the other side, the present value of forward is nothing but the spot. So, conclusion is that if I want to find the black model call and put, in that case, we don't take the position in the underlying, we take the position in the forward. So I'm not writing down the formula. You don't need to write. Just that understand when in the black model, what is the situation in the black model? Wherever you see the stock as 0, that is replaced by the present value of forward. And since we do continuous compounding, instead of this, I will rather write forward into exponential of e raised to RT. Are risk-free for time. Why do I write exponential? Because everything is in exponential term throughout the Black and Scholes. Fisher Black, Myron Scholes, and Robert C. Merton, Nobel Prize winners. Understood? This one single formula of Black and Scholes you will remember. With dividend, adjust the dividend in the spot. If they say black model, adjust the spot, replace the spot with present value of forwards. All the other formula of interest rate options, swaption, I tell students do it if you have time. Otherwise, you do not have to memorize any of these formulas. Even if you try to do so, it will be disaster. All right. You can skip all those formulas memorizing. Just remember the basic option, Black and Scholes for equity formula. All good, right? Let us do option Greeks. Option Greeks, we are very close to wrapping up derivatives. Option Greeks. What are the Greeks here? Delta, gamma, theta, rho, and vega. These are the option Greeks. They all will perhaps tell me what change in the option change in the option due to something. So delta of a call is change in the value of something due to something. They all will perhaps focus on the same thing. It is going to be change, 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 change. Delta means change. I always wondered, where am I going to use this delta in real life? Now I realize, oh, this is where I'm going to use it. Theta, rho, and then vega. Vega is also change. Now, very interesting is gamma, but let me discuss. I will discuss everything for call. The formula is same for put, just the signs will change. Delta is change in the, let's say for call, change in the value of call due to the change in underlying asset. But change in the change, that is change in the delta due to the change in underlying asset, is gamma. Are you with me? Theta is change in the underlying change in the value of call. All of these are change in the value of call, change in the value of call, change in the value of call. Theta due to time, rho due to risk free, and vega due to volatility. Understood? The first letter here, rho, risk free, vega, volatility, theta, time. Got it? In the revision, I've discussed that the call delta is positive, put delta is negative, gamma is always positive, vega is also always positive for call and put. Although I don't want to waste your time, but for call and put, remember the delta for call is always positive, put is negative, gamma is always positive, vega is also positive always. Theta keeps on decreasing because time is less in life, right? It never increases. So theta is negative, risk free is positive for call, negative for put. This is not formula, just a general discussion for your reference. Okay, this is how we use the option Greeks. Delta hedging, we have already discussed how to hedge the stock. Still, I will put up the delta hedging formula, which is also called the dynamic hedging, dynamic or delta hedging. What is that we do in delta or dynamic hedging? We try to find out how many number of shares we will take a position to hedge option. So if we have an option which we are stuck into a long call or a short call, long put or short put. So how many number of shares I need? So the number of underlying position. So the underlying position, everyone, divided by, I will do what? If my option position, how many number of shares I need? Underlying position, yes. Wait, I will write it properly. So if I want to hedge my option position, so against the option, let's say I want to hedge my call position. So for call position or for put position, how many shares I will take into consideration? Yes, how many shares? So actually the delta is what? Change in call divided by change in underlying asset. So can someone reshuffle the formula that we did? See, here we did for hedging, hedge underlying position is equal to how much? Delta into change, delta, that is hedge ratio, into option position. So if my option position will be equal to what? Underlying over delta. Option position will be underlying over delta, or if you want to find underlying position, it is same, delta into option position. All right. So simple. In this case, if I want to match the call position, how many underlying shares I need to take? So let's say I have 100 calls. So everyone in the class, how many shares I should buy? Check out this. This is where sometimes there is a confusion. Check out here. My underlying position is equal to what? Delta into option position. So if I have an option position, it should match equal to how much? It should match underlying position divided by delta. Are you getting my point? It should match underlying position divided by delta. If I have to match both, this is multiplied here. If it goes on the other side, it will be divided here if I have to match both. So if I have an option position, it should match to underlying stock divided by delta. Are you getting my point? The usage, it should be equal to my underlying position divided by the delta. Underlying position divided by the delta. Then they will match. Got it, everyone? Clear, 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 clear. So whatever is your underlying position, divide by the delta of call or put, depending on where your position is, that should match your call position. That's the last formula of your derivatives. Your derivatives has tremendous formula, but this formula, beyond this formula, there's a lot of concept. Very amazing. Majorly, people focus too much on Black and Scholes. Yes, Black and Scholes formula is important, but you should know the variant of Black and Scholes, not all. You just need to understand the basic call and put Black and Scholes formula. Perfect. All good till this point? Everyone clear? Yes. Okay. All right, we are now starting with alternative investments. Alternative investments have four readings, of which the major focus is going to be on real estate. The total number of formulas here are roughly around 20 to 25 formulas, and majority of the formulas are pretty much simple. Some of them are related to derivatives as well. All right, so let us start with the first topic, that is commodities. And in commodities, the formula that we should be aware about is the spread. Spread is the difference between the two prices, that is a spot and forward. But there are two types of spread that we should be very much aware about, is the basis spread and calendar spread. Basis spread, this is, by the way, we are in reading number 1. Basis spread and calendar spread. Yes, any idea what is basis spread? Basis spread is the difference between spot price and the future price. Basis spread is the difference between spot and future. Simple. Calendar spread is the difference between two futures price. One is the future, they both are future price. In calendar spread, both are future price. So it is a difference between the one which is the closest future. So let's say future T and the next month future or the next future, that is T plus 1. For example, let's say it's future of January and futures which expire in February. So it's a difference between the two. All right, everyone. Now, along with this, what is contango and what is backwardation? Contango and what is backwardation, which is simple. Contango is when forwards are greater than spot or less than spot, everyone. When forwards are, yes, forwards are greater than spot, it is contango. Less than spot, it is backwardation. Like in derivatives, when we did something called the no arbitrage forward price or future no arbitrage future price, in commodities also we do the same thing. No arbitrage future price, and it starts with the spot price as 0, price of the commodities today, into we take the risk-free rate, which is nothing but the time value of money, or this component that we add is also called as cost of capital, right? It is the cost of your investment. So this is your cost of capital. And then we add a cost and subtract a benefit. So we add a cost and subtract a benefit. Now, in commodities, what is the cost involved here, guys? What is the cost? The cost is called as the storage cost, right? Storage cost. So storage cost is what we add, and we subtract the benefit, which is what we call as convenience yield. Convenience yield. Convenience yield, remember, in commodities, it's not a monetary benefit like dividend or coupon that you have in bonds. It's a non-monetary benefit, which is the benefit of holding the physical commodity. So 1 plus risk-free rate, everyone in the class, that is your cost of capital. Your storage cost is your cost. Storage includes warehouse, insurance, everything. Convenience yield is the non-monetary benefit. These three components, in fact, these three components also have a name. What is that name called as? That name is called net cost of carry. So we call it as net cost of carry. All right. All of this, check now. Everything has a connection also. Basis, calendar spread, contango backwardation, no arbitrage, forward price, everyone. Now, what is the connection here? Just for your reference. If the cost is greater than benefit, if the cost is greater than benefit, then the forward is greater than spot, market is in contango. And if the forward or the future is greater than a spot, the basis spread is negative. Basis spread is negative. I'll repeat. If the cost is greater than benefit, the forward or future prices are greater than spot, market is in contango, basis spread is negative. Opposite is the case when the benefit is more than the cost. Calendar spread, if the market prices are increasing, guys, if the prices are increasing, if the curve, if the prices of commodities is upward, basis and calendar spread both are negative. Is that clear, everyone? Got it? All the formulas, just for your reference, check it again. Basis spread, calendar spread, contango backwardation, future prices. Under that, the component, what we say is the cost of carry. Got it? Okay. Yes. Now, let us focus on the total return under the commodity derivatives position for someone who has long futures. So we will find the total return for someone who is having long futures position in commodities. Long futures position in commodities. Now remember, total return is a combination of three things: collateral, price, and roll return. So I will write down total return is equal to collateral return, price return, and the third one, which is important, is roll return. All three, everyone. Inside all of these three also there are formulas. So first of all, this is the position for the long. So we are assuming the long will benefit. The long, of course, will benefit when the prices go up. Collateral return is generally always positive. It is the return on the collateral that you've posted for taking a position in derivatives. So whatever collateral has been posted, collateral is like a margin, right? So collateral posted, on that, how much is the yield earned or how much is the returns earned? So this return, it's like a margin rate or a loan. You have lent someone, so you will get an interest on it. So we say interest earned on the collateral, of course. So collateral return is nothing but the interest earned on the collateral. That is your collateral return. Generally, this is positive or negative? Interest earned on the collateral divided by the collateral posted. Is it positive or negative? Generally, collateral return is positive, right? It cannot be negative because you will not pay. You will receive because you have posted the collateral. You've given the deposits. Price return can be positive or negative. Price return is simple. You don't have to remember the formula here. Complicate. No need to complicate. It is simple. Ending minus beginning over the beginning price into 100. That is your simple price return. Technically, we write P1 minus P0 over P0. Ignore that. It's ending value minus beginning over beginning value. That is your price return. Remember the price at which you enter and price at which you exit, right? Long, long always will right now book a contract. If the market price goes up, the returns will be, price return will be positive, but it can be negative also if the prices goes down. Roll return is something that is interesting. We roll over the contracts. So for roll return, we exit one contract and enter into another contract. So the price of expiring contract, minus the price of the new contract that you are getting in. So price of the new contract, this price divided by the beginning price, and the beginning price here is the expiring price because you are exiting this price. So I will write down price expiring. Now I will explain you this. For example, you have taken a position in January. So you are exiting the January contract and entering into a Feb contract. So the January contract, assuming this is what we are doing from the point of view of long, right? Long. So you had a long position initially. At the end of the January, you will close it. So this is what you will receive. So January closing price, everyone, minus you will take another long position for getting into the Feb contract. So minus the Feb prices over the Jan prices. So Jan minus Feb over Jan. You can assume like this: Jan minus Feb. For your understanding, you can write this. Let's say this is a Jan contract minus the Feb contract price over the Jan contract price. That will make it easier for you to understand. Now, a question to everyone. If the market is in contango means the prices are increasing. If the prices are increasing, roll return will be, yes, roll return will be negative or positive. So if the market is in contango or backwardation, so if the prices are increasing, my Feb prices will be higher. So then roll return will be negative. Roll return will be negative or else positive. Is this clear to all? Understood? Commodity prices, all the formula of commodity in these two cases. This is all about the no arbitrage forward pricing. And then we are trying to find out the return components. Anyone has any doubt? Got it? All right. Now, the next reading is about real estate. Real estate related, there are two readings. One is a basic investment in real estate, where we will discuss about commercial properties and all and the valuation. But then the more interesting topic is REITs. So in the real estate, the first formula that you come across is to generate return. So when we calculate returns in real estate or profitability, we do it on the basis of NOI. NOI. So the most important formula in real estate is the calculation of net operating income. Now, just for your reference, in the notes, we have this net operating income discussed at length here. So you can see the net operating income we've already written, but let's break it down. It is you give your property and you earn some returns on it. So the core is only the rent. Basically, we will get the rent. So rental income is what we will start with. Rental income. Now, this is my cash inflow. So rental income is always positive, right? This rental income, and then we add other income. Rental income and any other income on the property, both of which are positive. This rental income is with the assumption that the property is fully occupied. So this is with the assumption that the property fully occupied. That means I will have to adjust for any vacancy also. So vacancy and collection losses. So if there is any vacancy or any collection losses, that is bad debts, vacancy and collection losses. Are this inflow? No, they are subtracted. This is if there is any vacancy or collection losses, you will carefully see. So rental income plus other income has a name which is very important and you should remember it is called gross potential rental income. We call it as, before we calculate the NAV, all of this, it is called gross potential potential. Potential means why? Because we are estimating, and at that time we are assuming it will be fully occupied. Gross potential rental income. From this, we will subtract the vacancy and collection losses. We will estimate that. That is called effective income. So this is going to be my effective rental income, or effective, we can say, gross income. Until now, we are still in the calculation of gross. From this, now this is the core income. This is where we've estimated how much will be occupied or not occupied. From this, we will subtract all our OPEX, operating expense. Operating expenses can be related to what? Taxes, maintenance, all your taxes on the property, maintenance charges on the property, right? All the insurance cost on the property, basically all the cost related to managing or maintaining the property, those are going to be your component in your OPEX, operating expense. After this, what you get is your NOI. The final amount is NOI. Is everyone clear with this? NOI, NOI, all good? Yes, rental income plus other income. Gross potential income minus vacancy and collection losses. That is your effective gross income. From that, you will subtract all the OPEX. Final amount is your NOI. Cool. Any questions? Wow, real estate, right? Next, when you give, when you go for real estate loan, or the lenders in this case will look at some measures whether you are in the position to borrow. That is called the debt capacity measures. There are two debt capacity measures that we should be aware. One is the debt service coverage ratio, and the second, very important, is LTV ratio. The name itself is the formula here. Debt service coverage ratio is now based on NOI because it's a commercial property. We are seeing the expected NOI. That is my capacity from the property, income capacity. Will that be sufficient enough to pay the debt? And when I say pay the debt, means debt service. Remember, debt service can be only interest, or it can be interest as well as principal. I'll repeat, debt service can be only interest, or it can be interest or principal. Basically, it's your installment, isn't it? That's your installment. Clear? LTV ratio, as the name suggests, it is loan divided by the property value, or we can say the, to be precise here, we say the appraised value. Yes, we say appraised value because we are going to not take the book value, that is the historical. We will take what is the latest fair value or appraised value. All right. Now we will calculate both measures, and the maximum loan, which is very, very important as per me and highly testable, the maximum loan amount will be maximum loan amount, highly testable in your exam, is, there are two ratios that we calculate: debt service coverage ratio and LTV ratio. Maximum loan amount is higher of the two or lower of the two? Is higher of the two or lower of the two? Maximum loan amount is, everyone, the lower of the two. Very good. So it is the minimum of these two. Minimum of these two will be your maximum loan amount. Is everyone clear with this? Written? Debt service coverage ratio, LTV ratio, and maximum loan amount. Highly testable. Got it? Yes. Now, a not so popular ratio, but there is a ratio which is called equity dividend rate. Equity dividend rate. Now, this is a ratio. Yes, it's in real estate. This is basically in in real estate, I'm not going to get dividend, right? So here the income that we are going to get is nothing but NOI. But when I say equity dividend rate, we will look at the net amount that I'm going to get. So here we actually take first, we take NOI. From that, we will pay our debt service. Debt service, as I said, can be interest or principal or both, right? So we will subtract the debt service. So that will tell us how much is the cash flow left, or what is the cash flow that I am expecting in the first year. So this is your NOI minus debt service. This amount is my final amount that is left with me on my investment amount, that is my equity. Remember, you may have taken loan. So let's say out of $100, you have taken $80 of loan. So the equity component is 20. This is similar to your ROE formula. Remember, it is similar to your return on equity, net income over total equity. So here the net income is nothing but NOI minus the debt service over equity. This NOI minus debt service is also called cash flow. All right. NOI minus debt service. Clear, everyone? Right. This is one formula which is again not so popular, but like a ROE formula that we need. In real estate, one thing that you should do is that this NOI calculation is very important. That will give us something which we will utilize to value the property. Yes. So these returns will help us to value the real estate. Real estate, to value real estate, we use three approaches: income, sales, and cost approach, same like equity. In real estate valuation, in the real estate valuation, under the income approach, same like Gordon's growth or same like dividend discount model, we use a direct capitalization approach. Direct capitalization approach. Under the capitalization approach, same like equity, we are going to find the value, but this time the value is of a property, correct? And in this case, same like Gordon's growth, what we did, we used D1 over R minus G, correct? Here, the D1 will be replaced with NOI expected over R minus G. Here, the R minus G has a name, which is what we call as cap rate. Cap rate. R minus G has a name, it is called cap rate. This is your direct capitalization method. If you notice, it is same like Gordon's growth method. It is a single stage constant growth model. This generally we apply when the company is going to, when the property is going to expect rental yield growing at a constant rate forever. The second method is like a multi-stage model, which is the DCF method. DCF method, it is no more different than what you did in equity, just that we will calculate NOI, subtract the debt service. That is what we will take the cash flow for multiple years. Let's say 1 year, 2 year, 3 year, etc. We'll take all the cash flows and then we will add the terminal value. Yes, we will add the terminal value. So we will take all the cash flows till the terminal year. We will take the summation of all the cash flows till the terminal year, and we will take the terminal value. All of this we will discount. So basically, all of this we will discount at the respective rate. And here the rate is nothing but our cost of equity in real estate, whatever equity we infuse. So real estate is also having its cost of capital. So here 1 plus R depending till the power t. Everyone, this is just a formality. In reality, you won't need this. You will be given multiple year NOI plus last year terminal value, pull it back, same like the DCF model that you use in dividend discount. All right. The formula which is new and unique to real estate is the cost approach. Yes. Cost approach. Cost approach is very commonly used in real estate because in real estate, we have to understand what is the replacement cost if we create the property. So this is used when you're making altogether a new property. So cost approach includes three component. It is replacement cost. Yes, this is one formula that is unique to real estate. Replacement cost minus the depreciation expense that will be charged each year. But to build up the property, you also have to invest in the land. So what we will do, plus the land value. So you will have to pay for the land also. So replacement cost minus the depreciation expense plus the land value. This is used when you are constructing a new property and when it is difficult to estimate. Right, everyone? The cost approach is a unique thing here. Rest all is pretty much simpler, doesn't have a complicated thing. These are the three. There is sales-based approach, which you will relate the property. There's no formula there, but direct capitalization, same as Gordon's growth. DCF, same as dividend discount model, multiple year. Cost approach is a unique 1 year. Got it, everyone? Clear? All good? Have written? Okay. In real estate, we also have indexes, appraisal index, transaction based index. In that, I will show you a formula related to appraisal index. Yes, look at this. Appraisal index returns when you are trying to derive the returns for index in real estate. In this case, what is appraisal index returns? Yes, so we will derive appraisal index returns under the real estate. All the returns you will notice they start with the formula has nothing but NOI. Instead of dividend, we have NOI. But when we look at the overall index, it will include all the cost also. So all the cost will be adjusted. So imagine I'm investing in the index. So whatever is the NOI, from that we will subtract something very interesting that is called the capex. Capex adjustment is the unique thing here. Otherwise the formula is same like your holding period return. If you know, holding period return is what? Change in price plus income, right? Change in price is nothing but ending value minus beginning value over beginning value into 100, right? It's the same thing. If you notice, it may look like a different formula, but if assume it was equity or bond, what is your holding period return? Ending minus beginning over beginning plus any income, which is this. The only thing which is unique here is capex. Capex is adjusted because to keep the property, there will have to be reinvestment in the capex. Is this clear, everyone? Right? That's the only difference. So don't get worried. Oh my God, how many formulas? Just understand. Just a capex component is new here. Otherwise, the index return is same. Cool. Right? This is where we cover all the formulas of real estate. But the next reading is of REIT. And in REIT, the very important formula when you invest in REIT, REITs are bought from the exchange like ETF. But the valuation of REIT is based on NAV per share. NAV per share is nothing but NAV over number of shares outstanding. There is a chance that we may be asked to derive the NAV per share in the entire tabular manner, but NAV is used as a component to find the fund value. To find the fund value. Now, this is different than finding the property value. Remember, for property value, we used a formula in order to find the V0, the intrinsic value. What formula did we use? We, instead of doing D1 over R minus G, we used NOI over R minus G. That is the cap rate, correct? This is for valuing the property. All right. But but for NAV per share, that is the fund value. property value is just one component. For fund, there are several other components. So a high chance that, and this is perhaps the only complicated thing that I came across, is the entire component of NAV per share calculation. Everyone. So this also we have described in depth in our concepts. You will see here, we wrote it down also. We first did NOI in the previous topic, right? This is where the entire table was calculated, right? So we will do the same thing one by one. We will break down the component. In fact, I generally suggest students that if you are worried that what exactly goes into it, remember NOI is always there. We need NOI. Once you get NOI, NOI, I just showed you to value. I need expected NOI. I will divide it with what? Divide it with the cap rate. Cap rate is nothing but R minus G. That will give me the value of my assets or value of my property, which is forecasted. So this portion is called estimated property value or estimated value of asset. Now, I will suggest you don't write until I complete it. I will first tell you how to derive this. See, we did the valuation here, correct? This valuation will help me derive only the property value. Now the question is how this NOI is derived. We know the basics of NOI, but for NAV per share, what exactly we will do? For example, to get the NOI, what are the components that we use? Rental income, other income. That is what is my focus here. Gross potential income. From that, we adjust the vacancy and collection. Then we got effective gross income. From that, we subtracted the OPEX. That is what we got our NOI. That NOI is also referred to as cash NOI. So all of these components that you see, they are called cash NOI. All of this are called cash NOI. So what we are going to do here, first to get the NOI, I will take the cash NOI, which we know how it is derived. Gross rental income, adjusted, we adjusted then several other items to get the effective gross rental income first. Everyone, gross potential income, vacancy collection, effective gross, and then OPEX. All of these adjustments, the final NOI that we got is called our cash NOI. There might be some adjustments needed. Yes. These adjustments, everyone, will be provided to us in the question. These adjustments are what? These adjustments, first of all, if there are no adjustments, the cash NOI is our NOI. Just remember this. If there are no adjustments, right? If there are adjustments, generally they are because of something called non-cash rent. Non-cash rent, that is one adjustment, or any other adjustment. So we will say non-cash rent or any other adjustment. Now this adjustment may be mentioned or not mentioned. Non-cash rent or any other adjustment like adjustment for acquisition, any other adjustment for acquisition. If the property is going to be acquired, in that case, what is the adjustment? So all of these adjustments, in case if mentioned, we adjust them or else we can ignore them. Just remember the non-cash rent here is an adjustment that they will provide. It is like a depreciation adjustment. Because for what? I will explain you in brief. The non-cash rent, when we estimate the property, we are assuming that over the next 5 years, I'll get a fixed rent. Okay. But in reality, there is always an overlapping period. Remember, the overlapping issue in real estate is that when a tenant exits, the new tenant may take time. So between that, the real rent that you receive and the estimated rent may not be same. Any adjustment related to that is called non-cash rent. I'll repeat, the real rent that you receive throughout the year. Let's say I said I will get $1,000 each month. So I'm expecting $12,000. But if a tenant exits at the end of fifth month and I get a new tenant maybe at seventh or eighth month, so my actual rent may not be same. So that adjustment is called non-cash rent. You may not require these adjustments. So it can be non-cash rent is something is generally like a depreciation. So we generally subtract the non-cash rent. Other adjustments can be plus or minus. You will wait for it. So basically this answer can be plus or minus. I generally tell students assume minus only because they will generally provide you non-cash rent. But again, formality, I will write plus minus both. If there is no adjustment, guys, then the NOI that we calculated is nothing, but it is same as your cash NOI. So your cash NOI and NOI is same. The matter doesn't stop here because this will only give me the estimated or forecasted property value. Once I get the property value, this is my value of assets, but I will add value of other intangible or value of other assets. Now, these other assets are which assets? So once I get this amount, there are other tangible assets. If there are other tangible assets, other tangible assets can include any asset that they probably will give us. We will not take intangible like goodwill or any deferred taxes. No, we will not take that. We will adjust for other tangible assets like land, etc. If you have all of this, will give you the total property value. From this, we will subtract if there is any liability. Yes, the fund might have taken any liabilities or there are any loans in terms of trading. These liabilities are adjusted finally. So because net asset is what? Asset minus liabilities, right? This will give me my total NAV divided by the number of shares. I will get my NAV per share. NAV per share. Watch out this. First, take the NOI. If there is any adjustment, do the adjustment into that. Then the final NOI you get divided by the cap rate, that is your estimated property value. If they give you any other tangible asset, tangible only, add that, subtract the liabilities, that's your net asset value, divide by the number of shares, that will be your NAV per share. Everyone clear with this? Very interesting. It's in the notes, but still. All good? Yes. This NAV per share, guys, NAV per share is the fund's value, but the fund is traded on the exchange. So we always compare this with the exchange price, and we compare the NAV per share. If on the exchange, the price is higher, we call it as premium. If it is lower, we call it as discount, as simple as that. All right. So always premium and discount is when you compare the NAV with the exchange price. Perfect. All good. Now, to value REITs, we require two unique things is that the multiple valuation. In the multiple valuation, NAV is one way to value a REIT, right? We also do relative valuation where we calculate price to FFO ratio and price to AFFO ratio. Price to FFO and price to AFFO. These are the two multiples that we focus in the REITs. Price to FFO and price to AFFO. Again, these ratios are used to value the REITs. Okay. So here FFO is what exactly? Fund flow from operation and adjusted fund flow from operation. Fund flow from operation is similar to your operating profit or operating cash flow to be precise, but adjusted free fund from adjusted FFO, fund flow from operation, is like FCFF. This is what I give hint to students that for your reference, treat FFO like operating cash flow, and treat AFFO like free cash flow. Okay. Now, what is the actual formula of FFO and and AFFO? So I will discuss these two formulas. It is less likely that they will ask you the components of the formula. They may rather make you test that formula. So what is your FFO and AFFO? Everyone, check out this. One minor difference between both. FFO is similar to what you did in case of net income, but net income is just earnings. If you want to convert that into cash flow, remember operating cash flow is net income plus non-cash, isn't it? So we do the same components, net income plus non-cash. Non-cash here will be depreciation and amortization on the property plus minus gain or loss on sale of property. Now remember here, gain or loss on sale of property is something similar to non-operating. Okay, so if there's a gain, we will subtract it, remove it, and if there is a loss, we will add. So it's simple adjustment. Here there is no issue related to working capital. So net income plus non-cash and plus minus gain or loss on sale of property. This is your FFO. FFO is relatively easier to calculate and most used in the industry. But a free cash flow will require reinvestment also. So in free cash flow, what we do, we take the FFO. From that, we do all the adjustments. These adjustments you will see are non-cash rent, which we discussed, non-cash rent adjustments, recurring maintenance, and leasing cost. So all the cost related to it. So that is the provision that we require. So all the provision for non-cash rent, this is the adjustment. Then maintenance, regular or recurring maintenance, right? Recurring maintenance. These are the costs that we will have to spend out, right? So they are removed like reinvestment. Also, whenever you do leasing, for that, any cost related to leasing, that is called leasing cost. Simple. All this will be provided. That is going to be your adjusted FFO. I'll personally tell you that FFO and adjusted FFO may not be tested in terms of calculate the components, but we are writing down the formula here. So just remember FFO is like a free cash flow, operating cash flow. AFFO is like a free cash flow because we will adjust for non-cash, recurring maintenance or leasing costs. So we will do a provision for that. That's the formula in REIT. My personal favorite from REIT is NAV per share. It includes NOI, highly testable. All right. There is a topic called hedge funds also, but hedge funds as such do not have any calculation. There are strategies about hedge funds. This is where we complete the alternative investments. Yes. Anyone has any questions? All right, everyone. Alternative investments clear. Around 20 to 25 of the formulas, pretty much simple, but NAV, NOI, these are crucial formulas because they look similar but slightly different. That slight variation here makes it a bit different. All good till this point, everyone? Perfect. Yes. Economics has only two readings, around 5 to 10 percentage of weight. The first reading is about currency, the second reading is about economic growth. Currency has a lot of formulas. Let us start with the base price. We all know that, right? So we're not getting into base and price. We will start with the basic formula, that is spread. And everyone knows what is the spread. So we are doing the first reading where there are too many important formulas related to currency. I will start with the easiest one. Spread is the difference between ask or the offer rate and the bid rate. Correct? Remember, ask is always greater than the bid. You should also be ready in case if they ask you mid quote in exam, it is simply ask plus bid divided by 2, a simple mean. That is your bid rate. If you have to inverse a bid code, so when I want to inverse a bid code and I want to inverse an ask code, what we do when I want to inverse a bid code or the new bid code, right? We do what? We take the inverse of older ask. It's not a formula, just for your reference. So bid is what? When I inverse the bid and ask, so the new bid will be, I should rather write the new bid instead of inverse. I should write the new bid will be inverse of older ask, and new ask will be inverse of older bid. Remember this, we have to do when we have bid and ask both, so that we are able to inverse and then apply. All right. These are all basic formulas. The one formula that we do it to calculate triangular arbitrage gain. And this formula, I would like to tell you, it's not in your notes. This is a formula that we have used in our lectures to make sure that we can get a shortcut answer. Do you remember this formula that we did in the class? It's a shortcut. We do that to find the arbitrage gain, that is identified bid over identified ask. Identified bid over identified ask minus 1, and multiply this with the capital or with the investment. So whatever is the capital that you're using in triangular arbitrage, you will multiply with that. That is your shortcut for triangular arbitrage gain. Very, very crucial. This formula, I'll repeat, it's not there in your curriculum notes, but this is a shortcut to get the answer. So you will have two bids and two ask. The rate that you choose to make sure that there is an arbitrage, the identified bid out of one currency's bid should be higher than another currency's ask. Yes. So that bid which is higher than the other currency, the other quotes, not other currency, other quotes ask, the ratio of that minus 1 into the capital. They may give $50,000, £20,000, 1 million euro, whatever it is. That's your arbitrage gain shortcut. Is everyone clear with this? Right? Have you written it? Cool. Remember this? Yes. Now, all the other formulas are related to parity, premium discount. For example, a simple premium, which is now something related to commodities also, we did premium or discount. Remember, the premium or discount is always the difference between the forward and the spot. It can also be calculated in percentage. So in percentage, we calculate annualized forward margin. Annualized forward margin is forward minus spot over spot into 100 into 360 over days. Remember, why do we do this 360 over days? To annualize. This will give me answer in percentage. This will give me the same premium discount answer in percentage. So premium discount can be calculated in uh, amount also. It can also be calculated in terms of percentage also. Clear, everyone? Till this point? All right. Okay. There is a very crucial concept similar to what we did in derivatives, that is mark to market valuation of forward. Yes, M to M, mark to market value of currency forward for the long. So this is value of currency forward, and we always do valuation from the point of view of long. Very, very important formula, even though it is similar to the derivatives. Remember here, you suppose here you had taken a forward position, long position in a currency. So you booked a forward price and then the market price increased. So we take the two forward price difference. Which forward price? The price that you booked initially, right? And then the price when you settle. Here I'm using T as the settlement period. Basically, this is the point at which you will close the contract. So it's similar to long and short difference. This difference, everyone in the class, multiplied with the contract size. Remember here, you have contract size because the trading is in quantity, right? All of this is supposed to be settled on maturity. So we will, if I have to find the value today, I will discount it with rate and multiply it d over 360. Why do I do this d over 360? Because I may be settling it earlier also. Everyone, a very, very important point. In currency, people do not realize that they get confused between which currency rate. When I say here R, this is the quote is always in which format? The quote is in which format, everyone? It is price slash base format. Always the entire syllabus is from the point of view of price slash base format. So this all quotation is for the base currency, but the base currency is traded in price currency. So the rate of interest, this is nothing but rate of interest of which currency? Rate of interest of price currency. Everyone, are you noticing this? Why price currency? Because the base currency, let's say dollar, is traded in the price currency. Clear, everyone? All right. This is unique. I hope you guys are understanding, writing, or recollecting. All good, everyone? Okay. Now comes a very interesting part, which is something highly testable, is the two parity, covered interest rate parity and uncovered interest rate parity. Plus, then there is a purchasing power parity also. So covered and uncovered interest rate parity. First of all, what is the meaning of covered? Covered means it is covered through the forward. So we use a forward rate to cover. In covered interest rate parity, we are going to get the forward premium or discount. And that premium or discount we will discuss here, and what we will get in uncovered interest rate parity. Very crucial. Students find it sometimes confusing, but the objective is very clear. We already know what is annualized forward margin. We calculated the forward premium or discount already. That premium or discount, that is F minus S, that F minus S, if I were to find the premium or the discount, this should be equal to the expected spot price. Now, what is the expected price? Expected with interest rate parity. So remember, interest rate parity is spot into 1 plus interest rate of price over base currency. Interest rate of price currency over base currency. This is the formula of parity. From this, we subtract 1. From this concept, we subtract 1. So the conclusion of this is similar to interest rate parity, which I will discuss in a moment. What exactly it concludes. Here, just remember that the rates are adjusted for time also. I just forgot to put up that. In case if there is a time factor, we will adjust. For example, let's say the rates are annual rates, but we are trying to do the forward for 90 days. So what I will do in that, I will adjust for the days. So we will do the days over 360. Days over 360. Remember 360 or 365, generally the institute defines. Otherwise, for forward, we use 360. This part will give me what? This both should match. Means the premium discount should match to this component. Spot into 1 plus interest rate of price over base currency minus 1. If you notice, this is nothing but a geometric adjustment. So if you rearrange everything, just check out. If I take the spot on the other side, this will become annualized forward margin, isn't it? This will become forward minus spot over spot. It will become like annualized forward margin, isn't it? So the conclusion is that the annualized forward margin should be approximately equal to the difference between interest rate of both the currency, that is price currency minus base currency. That is the most important conclusion of covered interest rate parity. Are you with me on this? Yes. Understood this? Very important. That means that the two countries' spot and forward difference is due to their interest rate difference. Due to their interest rate difference. Uncovered interest rate parity also says a similar thing, just that it says that the expected instead of forward, it says that the change in the expected. So it doesn't use the forward rate, it just says expected percentage change in spot. They shy away from using the word forward because we are assuming that we are not having a derivative market. So uncovered interest rate parity, spot of what? Again, price to base. I'll repeat, they say the same thing in a different manner. They are saying this should equal to what? The interest rate difference between price and base currency. Price currency and base currency. So you will find it similar only. Will they both match? Will they both match? Yes. Let me write it here only so that you can connect all. They both, if they both match, and under which case they both will match. Uncovered and covered interest rate parity, they both will match if the forward and expected spot are same. Remember, if the forward rate is same as expected spot, in that case my uncovered and covered interest rate parity and uncovered interest rate parity, they both are same. Whether I say covered or uncovered, they both are same if the forward and expected spot match. Clear, everyone? The formulas that you should remember. Conclusion is, you know what? That if one country's interest rate is higher than another, then the currency should be at discount. For example, if dollar interest rate is higher than euro, so dollar should be at discount. Vice versa, if euro is higher than dollar, then euro should be at discount, and the discount and premium should be equal to the interest rate difference. So let's say dollar interest rate is 3% higher than euro, then the value of dollar in forward should be 3% approximately discount. Understood the concept? Clear? That is a covered and uncovered interest rate parity. The remaining topic discusses on the inflation. So we all know from the quant's basic what is Fisher equation or Fisher effect. Fisher effect. Fisher effect has two, domestic and international. So I will discuss domestic Fisher effect and international Fisher effect. Very important. Okay. Fisher effect later on will connect with the parity as well. Domestic Fisher effect, what does it say? Domestic Fisher effect says similar thing that we have learned throughout the syllabus is that the difference between real and nominal is due to inflation. So the nominal rate and the real rate, let's say the nominal rate and the real rate, the difference between both is due to expected inflation, expected, forecasted inflation. That is your domestic Fisher effect or domestic Fisher relation. International Fisher relation says that the two countries' interest rate, nominal rate is different because of their inflation. So it says that the nominal rate. So if I say nominal rate of country A and nominal rate of country B, the difference between both is due to their inflation difference. So it is due to the inflation difference between the two countries. That is what international Fisher effect is. So if two countries have difference in interest rate, that is because one country and compared to another has relatively higher inflation. Understood, everyone? Clear? Yes. Based on this, we have parity. So we have purchasing power parity, PPP. PPP are of two types, absolute and relative. So we have absolute and relative. Under the relative also, we will have two types of parity. One, we have relative for the past, and then we have ex and relative. So we have relative, and then we say ex and relative for the forecasting. So three types of purchasing power parity. Everyone with me? Absolute parity actually focuses on what the basket of goods. So we say that the price of the goods, or here I can say the price of the currency. So let's say the spot price of a currency, which is price over base, price slash base, right? Price slash base. This basket will move with the inflation. And inflation in the two countries is measured using CPI. CPI is Consumer Price Index or the retail inflation in US. So it's CPI of price currency over base currency. So as the price currency inflation keeps increasing, the value of the basket, you'll have to pay more for the same basket. You'll have to pay more for buying that particular dollar amount goods. So let's say if the price for me is INR and dollar is my base currency. So if the interest rate of India keeps on increasing, I'll have to pay to buy more. I'll have to pay more INR to buy the same dollar amount of goods. So what was available at $1, I'll have to give more INR if the inflation is relatively high in India. Clear, everyone? All right. This is called my absolute PPP. Absolute PPP. Relative PPP does what? It compares the inflation of the two currencies, and that inflation is what we expect to be adjusted in the spot rate. So when I say percentage change, in the rate, percentage change in the rate, it is due to the inflation difference between the two currencies. Which currency? Price currency and base currency. Price currency and base currency. Price currency and base currency. So I will write down between the price currency and base currency. If it is ex ante is used for forecasting. So then we say expected inflation. Expected inflation. We use the forecasted inflation. Again, the formula will remain the same. It is the difference between the price currency's expected inflation and base currency's expected inflation. The conclusion means here, if the price currency, if its interest rate inflation is higher, the currency will be at discount. Connect the two dots. What? If the interest rate of currency A is higher, the currency A will be at discount. Similarly, if the inflation of currency A is higher, it will be at a discount. The price of the currency will fall. And the difference in inflation is due to what? The difference in, sorry, interest rate is due to inflation. So interest rate parity, inflation, or that is purchasing power parity, is connected with international Fisher effect. In the notes, in the revision book notes, everywhere I've used A, B, A, B, A, B. So if you notice throughout the notes, all that questions and everything that we did, you will notice all the formula are with respect to A slash B. Now, whenever I say A slash B, I mean what? Price slash base. So it is the price currency slash base currency. So it's the quote of base currency in terms of price currency, or you can say quote of B in terms of A. So who's the base currency here? B, and A is the price currency always. Okay. So if you see the formula as A slash B, do not worry. The base currency is the second part. That is price slash base format. Good, everyone? Understood all the formula at one place? clear between interest rate parity, purchasing power parity, international Fisher effect, domestic Fisher effect. All good, right? This was one section. The other section of the topic was theoretical. It was all about balance of payment and the different types of short-term and long-term theories. So all of those were about the macroeconomic part. In that case, there were no formulas, only concepts, 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 right? So currency, these are the formulas that you should be focusing on. Cool, right? Now, we will go to reading number 2, which actually is a very brief reading, but it has some very important formulas. The economic growth. And many students struggle with the formulas here. The one formula which is also what you have in multiple places coming up, that is in corporate or in equity, that is Greinhold Kroner returns. So remember equity return, we used it for risk premium. So Greinhold Kroner model, yes, Greinhold Kroner model was used to derive risk premium also, right? So that is used to derive risk premium or equity risk premium in corporate issuers. We use that, but it gives me what? It gives me expected return. Expected return. Very important, because expected return on equity is a combination of two things. Dividend yield, this is one component, and the second component is expected capital gains yield. So expected capital gains yield. Dividend yield is simple. It is dividend over price, expected dividend over price. So when you are investing in equity, whatever is a dividend over the price, that is simple dividend yield. Dividend yield is not complicated at all. So dividend yield is, I'll repeat, expected dividend over the price. Just for your reference, let us write it down. Dividend yield, even though it is provided, it is dividend over divided by the price. That is called your dividend yield. The more important is capital gains yield, because capital gains yield is broken down into several components. Let us understand all of these components. So capital gain is based on the growth. So it is based on the growth. So here we divide the we decompose the equity growth into I will put up all the differential here. So it is the EPS growth, that is the change in earnings per share. How much is the profitability of the company? That is called the EPS growth. We say EPS or change in EPS or EPS growth. I will rather write EPS growth. Okay, that is much better to write EPS growth. We will discuss about the EPS growth. See, EPS growth is one component. This growth is nominal, which can be broken into real and inflation. Then there is a change in the shares outstanding. If there are new shares issued, that will be adjusted. And the third component is changes in the PE ratio. Changes in the PE ratio. So EPS growth, we will discuss that. Changes in shares outstanding and changes in PE ratio. Remember of this, changes in share outstanding is minus and changes in PE ratio is plus. EPS growth rate is nominal, so it is a real growth rate plus expected inflation. Nominal is equal to real EPS growth. And of course, the difference between nominal and real is due to inflation. So we add the expected inflation also. See, wherever there is inflation used for forecasting, we use the expected inflation. Change in shares is because of the shares which are issued. The more the share issued, the lesser will be your EPS. So I'm assuming when I say changes in shares outstanding, I'm assuming more shares are issued. Changes in P ratio is called repricing. There's a further bifurcation of changes in shares also. You can skip that for now. When you're just revising the formula, don't go into that depth. Again, when you're doing it for the first time, yes, it's fine, but you don't have to go in further detail. Got it? Right? There is a formula for changes in share. Also, it is difference between the shares issued or shares buyback, right? That difference is generally negative. So the more the share issued, the lesser will be what? The lesser will be the outcome. So the gains yield will be lower. All right, everyone? Clear? All these components will be provided, but very important, granular chroner, it is repeated multiple times. So you may see this coming up. Now, all the very important formula are related to production function. That is how much should be the economic output. So what should be the economic output? Economic output means GDP. You will, as per the regression model, you will consider that as Y. So throughout this, you will see various formulas related to output. The first one and the very famous is Cobb-Douglas production function. Okay. Apologies for my spelling mistake, if any. Please bear with it. Production function. Cobb-Douglas production function. This will give me how much should be my output, that is Y. It is a combination of three factors of production: technology, labor, and capital. Technology, labor, and capital. So, yes, T stands for technology, K is for capital, and L is for labor. Everyone. The formula that we use here is something you may not be calculating it, but just for your reference, you should know this alpha and 1 minus alpha. What are these alpha? Alpha is the share of capital in the output. So I will write down alpha and 1 minus alpha. Alpha is the share of capital. K is capital, and 1 minus alpha is share of labor in what? In the total output, in the GDP. You can say in the GDP. So share of output, share of capital in the output, share of capital in output, or share of labor in the output. Okay, how much proportion of the economy is growing because of capital, how much it is growing because of labor. Everyone with me on this? Cool. Right, very important. Cobb-Douglas production function. You will see all of that in our notes here in the reading number 2. Let me go through this. Yes, you will see all the different types of production function. They also call this as output elasticity. Yeah, great. Output elasticity. Different names for this. Yes. All right. The model actually displays, we call constant return to scale, constant returns to scale. Now, there are several varieties of this used for various reasons. When this is going to give me total output. But when I want to calculate it based on per capita, so then we say output per worker or output per capita. So we say output per worker, which is like GDP per capita, GDP per capita. So in that case, my equation Y, I will divide it by L, that is output per worker or per labor, right? This will translate, the equation that we already did, right? Equals to T. T is total factor productivity, which will always remain. And then it will be K divided by L. K is capital divided by L. Again, capital's proportion is what we call as alpha. So to the power alpha. Again, you don't have to calculate this, but you should know that this is output per labor or GDP per capital. GDP per capita, sorry. Clear, everyone? All right. Yes. Now, these two formulas are further expanded into labor productivity growth. So here you will notice labor productivity growth is how does the economy grow? It comes from capital deepening and technological progress. Capital deepening and technological progress. Capital deepening is basically capital per unit of worker. So in your formula, this component that you see is called capital deepening. What is this called? Capital deepening. Okay, and the other component is technological growth, right? So if I now break down this into the growth, what are the components of growth, or what are the labor productivity growth? So we write down labor. If you can see the name labor productivity growth, labor productivity growth. This comes from two components. I'm just breaking down what we just generally did. It is growth from capital deepening, that is K over L, and growth from technology. So we can write down it is growth from what? So growth from two things, growth from capital deepening and growth from technological progress. Growth from capital deepening. Capital deepening, I'll repeat, is nothing but K over L, capital per labor. All right. This is one basic formula, and capital deepening has diminishing returns. So the most important formula of this topic is growth in potential GDP. Yes, that is something you should expect in exam. Growth in potential GDP. This formula that you saw here, Cobb-Douglas production function, it has three components. Now to break down into calculation, this growth in potential GDP again focuses on technology, capital, and labor. So we write change in technology, that is A over A. A change in absolute change in A over A. A is nothing but, here we consider that A is growth rate in technology. So this is, what is this component called as? This change. This change is called long-term growth in technology. Okay, I'm writing short form. This is one component. The other component is due to changes in capital, change in capital, and change in labor. But remember, change in capital and labor has their share. So we multiply change in capital with their share, which we denoted. We will multiply that with alpha. And this will be, I will have to break it down here. I will rather break it down here. This will be alpha. And this will be into 1 minus alpha. All right. So this, now you will see three components. One is due to technology, one due to capital, and the other due to, this is the formula that you will do in calculation. So this formula that you saw, Cobb-Douglas production function, it's not used for calculation. For calculation, we use growth in potential GDP. This is the formula that you will use for calculation in your exam. So these are all the long-term growth in technology. I will say the same thing, long-term growth in what? In capital, long-term growth in labor. Labor is what we will discuss into their share, into alpha, into 1 minus alpha. This is what, as per me, the most important thing, right? Now, under this, very interesting thing is the several components of this formula which are testable in exam. Everyone, right? First of all, this is the most important formula as per me. Okay. If I want to further down this, there is something called potential GDP growth. All may sound similar, but you should be ready to understand all potential GDP growth. Now, in reality, the GDP will grow due to labor force and labor productivity. I will write down, that is growth in, it will grow in what? Growth in what? Growth in, we say labor force. Labor force is the quantity of people, and labor productivity. Labor productivity is nothing but Productivity is nothing but due to capital and technology. So all the three components are already here. So this is nothing but due to capital and technology. All right. Growth in labor force and growth in productivity. How skilled is your labor? That is dependent on investment in technology and capital. For a developed economy, the growth will be from technology only. Capital has diminishing returns. All right. Now the focus is on what about the growth in labor force? Labor force will grow. When will the labor force grow? When the labor supply will grow and labor participation will grow. So two components here. We have to understand what is labor supply, and labor supply is based on the people in the labor force. Labor force basically are those people who are in the working age population and those who are working. So labor force are those who are in the working age population. Let's say the working age population is between 18 to 60. So all those people in the working age population into the number of hours that they work. So this is what we call average hours worked. Average hours worked. This is the labor supply. So let's say, a country like India, which has more than 50 billion. So how many people we have? We have 1.5 billion. So more than half of the population, right? Almost 700 million people are in the labor force. And how many hours they work, that is going to be my labor supply. But labor force means not everyone who's in the working age population is not working. So let's say many are not working, many are probably ill, or many are not willing to work, they are probably doing the homework. So labor force has also a ratio which is called labor force participation ratio. Labor force participation ratio. Understand this very carefully. It means that not everyone in the labor force is in the working age is in the labor force. So working age population. So I will take the working age population. So let's say there are 700 million people in the working age population of India. India and Saudi Arabia are the countries which have right now on an average the highest younger population. So working age population 750 million. Of that, let's say only 50% people are in the labor force who are working. So that is my labor force, the amount of people working. So labor force is basically those who are actually working. Not everyone in the working age population is working. So those labor force into the average hour works is my labor supply. That increase in labor supply is actually diminishing. You know why? Because the average hour works are going down. Today, due to ESG, environment, social, and governance, average hours working are going down. So growth in labor force is going down. So now it is about growth in productivity, which is investment in technology and capital. Capital deepening has limitations. So it is growth in technology only, which will lead to the future growth. That was the conclusion. Understood this, everyone? Clear? Finally, there are some growth convergence theories. In that, there is a theory called neoclassical theory of growth. These are growth theories, and which is also called solo theory. Solo theory. These are neoclassical growth theories. Under this theory, we have sustainable growth of output per capita. So we have a formula called sustainable growth output. We have total also, and we have sustainable growth output. Now, to have a precise name, I will rather go here so that you understand all this we did in the revision also. This is sustainable growth output per capita and sustainable growth of output. So this is total and this is per capita. The first one is per capita formula and this is total. Two formulas, per capita and total. So I will also say sustainable growth output per capita, and second one, we don't write anything, that is the total. So these two formulas very critical: sustainable growth output. Critical in the sense because they are a bit, confusing for students. So here we are measuring the growth rate. How much will be the growth rate in the economy? So this is growth driven by what? They are also based on Cobb Douglas. So you can use the reference here. This is also based on Cobb Douglas, everyone. So neoclassical theory, solo theory, or Cobb Douglas theory for sustainable growth rate. They are saying the only sustainable growth rate is due to growth in technology, isn't it? So growth in technology, we say growth in technology. Okay, growth in technology. That is what is sustainable. Growth in technology divide by the share of labor. What is the share of labor? Alpha or 1 minus alpha? It is 1 minus alpha. 1 minus alpha. This is common under the both. So this is per capita, right? Per capita means the share of labor. But when I say sustainable growth of output, in that we take the total quantity. So we also add one more component. That component is change in the labor, change in the L. Remember, this change in labor is a component added if I'm just finding the total. But if I'm doing per capita, I don't need to add. Everyone understood? This was the last formula. So, too many formulas about growth. My favorite is output per worker. And for calculation, you may see growth in potential GDP. This formula, highly testable. Highly testable. Other formulas are there. We've written it. But these are the formulas. All right. This is what currency and economic growth. Economics is pretty much simple. Economics is not so complicated like other topics. Two readings only, highly scoring. Sometimes formulas become an issue. Otherwise, the formulas are also limited. So this should not be a burden. This should be rather your strength. Unfortunately, the exam weightage is 5 to 10%. So you may see around one vignette. All good, everyone? Yes. Okay. Any questions? All right.